Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. Shares in CoreWeave pop after the AI cloud provider beats on the top and bottom line, while Supermicro also gains as the data center infrastructure stock issues up big guidance.
Futures in a holding pattern as investors await the latest US inflation print. The headline figure is expected to come in at 3.4%, with no clear consensus on how the Fed moves next. Oil extends gains as attacks on shipping heighten supply concerns and raise fears of escalation, while a top Iranian security official doubles down on Tehran's demands to reopen the Strait of Hormuz.
It was quite a day for markets yesterday, a reversal taking place across the board on the back of what have been a lot of records in recent trading weeks. The Dow down to the tune of just over 1/3%. Big moving stocks, the likes of Alphabet to the downside. We saw the S&P 500 also slide by a similar amount. A slightly stepped up selling on the Nasdaq 6/10 there. And again, it was Alphabet leading the moves lower. What we had in terms of some of the sectors, FANG plus stocks, they were down. So some of the tech euphoria just coming into the mix yesterday and fading. So just seeing the flip side of that trade. And banking stocks, though, you did see a little bit of appetite there. That was up about 8/10. So in terms of the technology trade that we've seen to date, thanks to some of the earnings coming through, it just seemed to lose a little bit of steam in session. But let's just take a look at US futures to see how we are perched, because a lot of numbers again after hours from the tech stocks. And what we're seeing is the Nasdaq seen higher at this hour, expected to gain modest territory along with the S&P 500. And speaking of tech news, CoreWeave shares surged in extended trade after the key AI bellwether hiked its capex forecast on the back of earnings that beat on both the top and bottom lines. The company now sees capex coming in at $39 billion this year. That is up $4 billion from the previous top end of its range. This as it reported a revenue backlog of more than $100 billion, up nearly 250% on the year, with another $25 billion in net new customer commitments so far this quarter. I mean, these are monster numbers we're talking. It will bring a measure of welcome certainty to investors, especially as CoreWeave says more than half of the backlog is attached to a contract where customer delivery has already begun. Our US colleagues will continue this conversation, speaking to the CoreWeave CEO, Michael Andretta, at 2 o'clock London time. Don't miss that conversation. It is first on CNBC. And switching over to shares in Supermicro Computer, which rallied almost 8% in extended trade after the data center infrastructure company topped expectations for Q1 earnings and revenue guidance. The company now expects up to $15.5 billion in first quarter revenue, ahead of an estimate for $11.7 billion. And don't forget Cisco on later too after the bell.
And all of that setting the tone for the Asian trading session. This is the picture across the main equity markets in the region as things stand. The Nikkei 225 returning after a public holiday and very decisively in positive territory. Some of the other big tech names helping to lift the Korean benchmark, the Kospi, as well as we're seeing positive moves on the Shanghai Composite. The Hang Seng trailing the pack there, off by around 1%. I mentioned the Korean tech names. They have rallied on the back of that positive update from CoreWeave and Super Microelectronics, Supermicrocomputers. We've seen, look at that, Samsung up almost 7%. SK Hynix, the other big chip maker on the Korean index, up more than 5%. They are a big part, they make up a big chunk of the Korean index, more than 40% of it. So that has helped to lift the broader benchmark. In terms of what's expected in Europe when the trading session gets underway, this is a slightly more negative picture than we've seen in Asia currently, but investors moving cautiously, it's fair to say, ahead of that US inflation data. Very much a split view on what the Fed does next, depending on how hot the print comes in for those price rises. And in fact, let's delve into that in a little more detail, because today's CPI report could well end up being pivotal for the Fed's next decision, which is due in September. Indicators are all in place to push investors to expect another hot inflation print, with Brent crude trading around 25% higher since the start of the Iran war. That has helped to push the annual CPI figure up by nearly 2 whole percentage points since the beginning of the year. Inflation coming in at more than double the Fed's target in May raised expectations of an interest rate hike, but then June's print, came in markedly lower than expected, as did the figures for the other part of the Fed's dual mandate, employment. The US economy has actually started to shed jobs, according to July's non-farm payrolls report, which came in at minus 20,000 compared to expectations of an 80,000 uptick. Now, today's inflation figure is expected to come in at 3.4% on the year, nearly 1.5 times the Fed's 2% target. Yet investors are very much on the fence on what that means at the FOMC's next decision meeting. What do the banks think? Good question. Bank of America says that June's soft figure was a one-off and that a strong print today will put a September hike in play, pending next month's PCE reading. Meanwhile, Wells Fargo points to the spectre of stagflation, especially after July's negative jobs print. What does Paul Donovan at UBS think? Well, he can tell us himself. He's the chief economist there and joins us live now. Paul, what's your take on it? The jobs figures suggesting that the Fed would be inclined perhaps to cut or hold rates. The inflation figures pointing more towards the need for a hike. What's your take?
Well, I think with the inflation numbers, what we've got to look at is the direction of travel. As long as inflation is slowly coming down, I think the Fed is going to be content to hold for the time being. And that, it has to be said, is the view of quite a large majority of economists in the markets who are suggesting that the Fed should be on hold while we see disinflation forces slowly coming through. The main driver of inflation at the moment is the oil price. If we look at core inflation, which is what the Fed focuses on, if it wasn't for the oil price, core inflation would be about 2% today, because oil prices affect things like airfares, which are part of the core inflation number. So we're in, I think, a relatively benign picture. As long as that inflation number keeps coming down, albeit slowly, I think the Fed is going to be content to sit back for the time being.
And yet we've had this sort of sequence of inflation prints, not just in the US, but generally, that has proved expectations to be quite wrong. I mean, the last US inflation print, much lower than expected. Do you think the inflationary fears have been overplayed and overblown?
I think that there has perhaps been a little bit of a problem coming back from the 2022 inflation episode. Now, the 2022 inflation episode, or really 3 inflation episodes back to back, was a very, very unusual set of circumstances. And the problem with that is that it doesn't matter that 2022 was a really peculiar set of circumstances. Your mathematical economic models are still going to incorporate that peculiar outcome into their history when they're trying to consider the future. So that may at the margin be giving us this slight skew. It's certainly the case that very recently, most of the inflation numbers have been coming in lower than expected across the developed world. I mean, it's not just a US thing, not dramatically lower. It's not like, my goodness, we're heading into deflation territory. Nothing like that. But the numbers have been coming in just a fraction lower than expected across so many countries. You do have to wonder if perhaps there's been a little bit of a pessimistic skew on inflation, just a small one, coming through from over-reliance on that 2022 experience.
Paul, there's been a lot of variables too. We talk about the tariffs and the fading effect of those tariffs as we see various changes on whether they can be applied or not applied, as well as the situation through the Strait of Hormuz. That has been incredibly elusive, trying to achieve a resolution. What do you make of the potential, though, for higher oil prices if we still see an unsettled situation persisting?
Well, I think the first thing we have to acknowledge is that the price the consumer is paying, the gasoline price, the diesel price, is already a lot higher. Now, most consumers in the States think that, the fair price for a US gallon of gasoline is somewhere around $2.50, certainly below $3 a gallon. And here we are well over $4 a gallon. So the inflation perception around around oil prices is already very negative. And the higher refined oil prices is reflecting the disruption not just to the crude oil supply, but also to the refined oil supply. So we've got to bear in mind that we've actually probably seen a bigger oil price impact than the crude oil price suggests. What we've got now, of course, is people have adapted. So that's an important point. The oil price is not as potent as it used to be, but it is a damaging effect as far as consumer perceptions are concerned. And that's where we've got to be concerned. That has political consequences, and it might change consumer behavior. No evidence of that so far, but it's something that maybe next year, persistent high oil prices could be a damage to consumer behavior.
Yeah, I was just pointing out the IMF also indicating in a blog that we are seeing prices not really reflect the shortage that exists out there. I want to bring up to the chip story, Paul, because chip inflation, we've been watching it play out in real time. We've seen Apple having to absorb a lot of those costs, and it's not just one company. It is across the board impacting a lot of the producer prices and spilling across now into consumer prices as well. How serious is the chip inflation story in your view?
I don't think it is something to get overly concerned about. We've got to remember that consumer electronics, although it seems they dominate our lives because of course we can never be off our phones, in actual fact they're quite a low weight in the overall consumer price inflation basket. So that's the first point. And the second point is that we have to remember that actually, when you go out and you buy an iPhone or whatever, you're not really paying for chips. The chip is a tiny part of what the consumer's paying. Most of the cost that they're paying for is labor cost in the wholesale and retail and distribution, and then the fancy packaging that it all comes in, and then the advertising campaigns, all the rest of it. That's what you're paying for. And so when you break it down, the impact of higher chip prices on the consumer price paid for electronics and the impact of that then through to the inflation number, I wouldn't dismiss it entirely, but it's not a key indicator as we look ahead.
Paul, the market looking for some clear signals around CPI today and price stability, but the bigger issue seems to be managing this economic cycle. This incredible AI build out, whether it's sustainable or whether there's circularity risk, something that's going to bring this whole big investment wave unstuck. What's your interpretation of the facts we have today and whether the risks are elevated?
Well, we've got a complicated position here, of course, because a lot of the drivers of growth, particularly in the United States, are very, very narrowly focused. I mean, for example, most people in the United States, the overwhelming majority of the population, are living in a European economy. They're experiencing European-style growth rates, European or sub-European living standards. What you've got is a very concentrated growth story, very focused on investment and particularly the AI build-out. Now, there's nothing wrong in that particularly, but it does mean you get a slightly distorted picture. When we look at the underlying consumer spending, the consumer balance sheet does remain strong. That is something I think that still sustains us going into the end of this year. And that's been the really unusual feature of this whole crisis. The consumer's strength, their ability to draw down their savings rate, and on some occasions to tap their stock of savings to maintain consumption, that's not something we normally experience. And that's been the structural difference this time around, I would say.
Paul, just while we've got you, I want to get your thoughts on one of the other big sort of macro factors that's at play today, and that's the yen. I know you've written about it in your daily note. It is heading back towards 160 to the dollar, giving up a lot of the strengthening from that joint intervention. What happens next with that, and what does it tell us about America's ability to influence the bigger global economy in what would have traditionally been seen as its role and its strength?
Right, so let's go back to the basics here. Foreign exchange intervention works under one of two circumstances. It works if there has been a speculative attack against a currency, and it works if you use the period after the intervention to change the policies that have caused the currency to weaken in the first place. So either there has to be a speculative attack or you've got to change the economic fundamentals. Well, I think you've just got to look at a chart of the yen to see this wasn't a speculative attack. The yen has been weakening over a period of time. And so I think it's very hard to portray this as sort of speculators hurling the dice on the currency and gambling away. And so the intervention has got no speculator to defeat. Has there been a change of policy, either from the United States or from Japan, which is going to change the drivers of currency fundamentals? There has not. And so you're not seeing anything, I think, particularly unusual. The yen was trading at what the market thought of as fair value before the intervention. You get a period of intervention, which is a very big distortion in the market. And once that distortion has passed through, the market tries to go back to the perception of fundamental fair value. So yes, inevitably you're going to see the yen weaken unless we hear a different policy position coming out of the United States or out of the Japanese authorities. And we're just not hearing that at the moment.
OK. Paul, thank you very much. Paul Donovan, Chief Economist at UBS GWM. Still to come here on the show, new attacks on shipping also raise escalation fears in the Middle East as Iran's newly appointed National Security Council Secretary insists the Strait of Hormuz will remain closed until the US accepts its conditions. Dan will bring us the latest. Plus, countries are taking more extreme measures to tackle drought, wreaking havoc across Europe. Some of those measures may well surprise you. Sam will join us to explain more after the break. And we'll delve into Q2 earnings with Vestas CEO Henrik Andersen. That conversation is coming up at 7:45 London time. Welcome back. Ukraine has given US negotiators fresh proposals to end the war with Russia, according to President Volodymyr Zelensky, as talks to end the more than 4-year conflict remain largely stalled. The Ukrainian leader did not offer any details on the proposals. Zelensky also said Ukrainian intelligence has evidence that Russian President Vladimir Putin will use next month's parliamentary election results to announce a new mobilization. President Zelensky has said that Russia used ballistic missiles supplied by North Korea in an attack in the southeast of the country. In an address, he said that for the first time, Russia could not fight without reinforcements from its ally. However, provided no evidence for his claims. Ukraine has reportedly halted its campaign of drone strikes on oil tankers in the Black Sea following a request from the US Vice President J.D. Vance. According to the Financial Times, citing Ukrainian officials, Vance asked to stop attacks last month after it became alarmed that the moves were further destabilising oil markets and harming US companies.
Iran's newly appointed Supreme National Security Council secretary has doubled down on Tehran's stance that the Strait of Hormuz will remain closed unless the US accepts a series of conditions, including an end to the war and release of frozen assets. This despite mediators on Tuesday signalling progress towards an agreement. Separate attacks on shipping also raising escalation fears. The US said it disabled a Panama-flagged vessel attempting to violate its blockade against Iran, while 6 people were killed in a suspected Houthi attack in the Bab el-Mandeb Strait. Let's get out to Dan for more. Dan, it feels as though the negotiations are going on with live artillery at this stage.
That's right, Karen. Negotiations at a stalemate. And then, as you flagged, we've also seen fresh attacks on shipping that are really keeping escalation fears high across the region. As you mentioned, in the Gulf of Oman, the US military says a Navy helicopter fired 2 Hellfire missiles at a Panama-flagged cargo ship after it ignored warnings and tried to breach the US naval blockade on Iranian ports. That strike reportedly disabled the vessel. And then in the Bab el-Mandeb Strait, Yemen's Houthis have been blamed for a deadly attack on a cargo ship. 4 crew members were killed, along with 2 Yemeni rescuers in a follow-up strike. The attacks coming as hopes for a quick end to the US-Iran war continue to fade. On the issue around the Strait of Hormuz, well, Iran now says the strait will remain closed unless Washington accepts its conditions, effectively doubling down on that previous list of demands. And then on the other side, President Trump, of course, insisting that the US remains in control of that waterway. And then we've had regional reaction as well that I wanted to bring you across this morning. This is from the UAE presidential advisor, Dr. Anwar Gargash, who says the region cannot remain in a state of neither war nor peace indefinitely. Meanwhile, the US Energy Secretary Chris Wright also weighing in. He says almost 9 million barrels a day are now moving through Hormuz, with total regional oil flows at around 15 million barrels a day. Important to point out here, though, that Hormuz estimate well above some independent tanker tracker figures that we watch closely. So these numbers from his part of the administration are being treated with some caution, but nevertheless, the US still optimistic that ships are being able to pass through the Strait of Hormuz effectively under US control here, bypassing that US blockade. Of course, the Iranians would argue otherwise. So the situation remaining effectively in a stalemate at this point. And of course, oil prices also pushing back towards that 90 USD handle on Brent as traders continue to digest this escalation and these latest headlines.
Dan, I've got to ask you about the security tactics by the Americans in Turkey last month. The Washington Post effectively breaking cover on this story about how the president was moved from Air Force One to a military aircraft trying to protect his security. It's been an incredible story.
It's extraordinary, Karen. And what's also interesting is the fact that the president has all but confirmed that this happened. 2 points to make here. I think, first of all, an extraordinary play by the Secret Service in the United States, responding to what was believed to be a genuine and real threat from the Iranians on the president's life that ultimately resulted in him being forced to switch planes while on the ground in Turkey. The second point to make here is that this was not necessarily your typical executive transfer switch, right? Because there's also a bit of an uproar coming out of the United States. The fact that journalists were left on board the original Air Force One, which was being used as a decoy, certainly raising some eyebrows among the press corps stateside.
Indeed, Marco Rubio on that plane too. Just extraordinary. Dan Murphy with us. Thank you so much for that. I want to push on to Foxconn. Breaking news at this hour. This is a closely watched company for the extent of the AI demand story right at source. And as you talk about the key supply here to many of the major device makers, the company has produced Q2 net profit of $59.97 billion. This is slightly above analysts' expectations. On 2026 revenue, expects to see strong growth year over year versus the previous forecast of strong growth, so that remains intact. In terms of what we're seeing on the revenue for the cloud and networking products, to see strong growth there as well. Revenue for smart consumer electronics to see significant growth, so slight change in terminology there versus the networking product side. And the company also going on to talk about components and other products seeing significant growth there. This does give a fairly strong view as it talks about AI infrastructure is driving growth. I think we all know that when it comes to the data center, that is very much a driving force. So that is decent. 2026 AI server rack shipments to more than double is the line that is crossed in the third quarter. AI server rack shipments to rise high double digits on the quarter. And we are, of course, seeing that play out in other companies. So I think just a reflection almost of what we're seeing from the other big tech players. And we saw it overnight in terms of CoreWeave, Supermicro also talking about the demand coming through for compute, Ben.
Yeah, indeed. Let's see how that all plays out. We have got the European market open. We are counting down. Just over half an hour to go, and picture slightly improving for the Pan-European Stocks 50 Blue Chip Index, just being called above the flat line. The others, though, being called in negative territory. We will be back right after a short break.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Brillos. These are your headlines. Norway's sovereign wealth fund posts a record $184 billion in first half profit as investments in tech, telecoms and energy pay off. Shares in CoreWeave pop after the AI cloud provider beats on the top and bottom line, while Supermicro also gains as the data center infrastructure stock issues upbeat guidance. Futures in a holding pattern as investors await the latest US inflation print. The headline figure is expected to come in at 3.4% with no clear consensus on how the Fed moves next. Meanwhile, oil extends gains as attacks on shipping heighten supply concerns and raise fears of escalation, while a top Iranian security official doubles down on Tehran's demands to reopen the Strait of Hormuz.
So So this was the picture at the close of trading yesterday on Wall Street. The Dow posting back-to-back losses, closing around 1/3% lower. The S&P 500 also retreating, and the Nasdaq leading the losses, down 0.6%, coming clearly off the recent highs that we have seen. This has sort of been setting the tone ahead of the CPI print that we are getting. Investors moving somewhat cautiously. Very unclear picture as to what the Fed may do, especially if the inflation print comes in hotter than expected. Its next meeting is due in September, and bets have shifted as to what is being expected in terms of movement on interest rates. We'll come on to that in a little more detail at the moment. But it was a bit of a positive session, more positive in the Asian trading day. This is the picture across the key benchmarks, with the exception of the Hang Seng. The other regional benchmarks all in positive territory. The Kospi leading the way higher, buoyed by some of those positive updates we saw from the big tech names in the US after the Wall Street closing bell. We saw some of those move sharply higher in after-hours trade. That has boosted some of the key components on the Korean market. SK Hynix and Samsung both up, helping to lift the broader index more than 3.6%. Unfortunately, that hasn't really filtered through. Europe hasn't got the memo about the rally in Asian markets. It's being called negative for the start of the trading day. The FTSE in particular, pointing to open about 0.5% lower, unchanged on the pan-European blue chip stocks 50, and the DAX also being called just below the flat line. I mentioned the US inflation print. We get that later today, and it's affecting treasuries, but not in the way you might expect, given that we're expecting inflation to have gone up by a fraction. Consensus is that we will see it have sped up, price rises have sped up compared with the previous month. Treasuries across the curve all easing slightly. As I say, a lot of difference in terms of what's being expected for that Fed meeting in September. Karen.
Extreme heat warnings have been issued in Britain and France this week, with temperatures set to reach around the mid-30 degrees Celsius level. Governments have taken action. More than 27 million people in the UK are facing water use restrictions as Brits face their 5th heat wave this year. UK Prime Minister Andy Burnham is set to chair an emergency COBRA meeting this afternoon in response to the sweltering heat. This June and July have been the hottest on record in Western Europe. That's according to the European Union's Climate Change Monitor. Research shows the region's average temperature across the 2 months was almost 3 degrees Celsius higher than usual. The report warned climate change is intensifying extreme weather conditions, with heat and drought reinforcing each other across the region. Severe weather conditions are forcing countries to take extreme measures. Romania recently resorting to carrying out underwater detonations to divert water needed to run its nuclear power plant. Well, Sam joins us with more. Sam, you've been writing an extraordinary article on what some European countries are doing to manage what are low levels of water in some of the rivers, key transport corridors, but trying to ensure key infrastructure remains safe.
Exactly. Yeah, good morning. I mean, we are seeing Europe's rivers falling to record low levels. Clearly, that's an environmental problem as well, but it's also a massive economic headache. And the Rhine and Danube rivers are two good examples here, because after a series of heat waves and an exceptionally hot and dry summer, we're seeing governments take pretty drastic action. You've already alluded to one in Romania, those images of naval forces conducting a controlled explosion to try and improve water flow to the cooling systems of its nuclear power plant. That was extraordinary as a desperate measure to take. In Germany as well, with the River Rhine, this runs through its industrial heartland. It's a vital economic artery, actually, for Europe's traditional growth engine. We're seeing cargo traffic severely disrupted, and that's expected to have a significant economic impact as well. So with the issue of water security, it's a known issue. It's not something that's new, but as the climate gets hotter and these droughts get more extreme, these rivers, these economic fault lines, if you want to frame it this way, they are coming under real pressure.
Shipping lanes very much in focus as we talk about the Strait of Hormuz and very different issues playing out there. But the Panama Canal has also been facing problems with low water levels and has jacked up prices because of that. It feels as though the response we're seeing in Europe is an emergency response this summer. Do you think there's going to be more long-term planning to manage what is going to be a challenge of this decade?
I think there will have to be. Yeah, we're seeing emergency measures even today. I think you mentioned the UK government is having an emergency meeting too to discuss issues similar to this. But even shippers in Germany, just to bring it back to the Rhine specifically, they've warned that the Rhine could actually split in two, such as the water levels are being so low. So that would obviously mean that traffic can't navigate the whole waterway, and that further complicates this problem.
That's fascinating. Sam, thank you so much for setting us up also for our next conversation. We appreciate that. And for more around Sam's full piece, you can head over to cnbc.com. Gareth Redmond-King is head of International Program Energy and Climate Intelligence Unit. Gareth, you've probably just heard the conversation we're having here on the set around the emergency measures that Europe has resorted to around the Rhine and the Danube. Just weigh in on this and the challenge that we face today around these key rivers that are carrying cargo and other precious things that we require for economies to function seamlessly.
I think emergency response is right, and I think many would suggest that treating this as an emergency is perhaps a little overdue. What this extreme heat and all of these knock-on impacts, including the wildfires as well as the drought that's affecting the rivers, what they tell us is that our climate system is in crisis, and this is not something that is simply going to pass. We've seen what happens with these very short-term, so far short-term intense periods of disruption to trade supply. We saw what happened with slightly longer disruption to trade supply in COVID. This promises to continue, not just as we're seeing it this summer, but continue to get worse and worse if we continue to burn fossil fuels, add greenhouse gases to the atmosphere, and drive that temperature even higher. Then we push the climate system into even greater crisis.
There's no doubt there is a climate change challenge when it comes to policy and how we're addressing that. But in the immediate time, as we try and get some movement that brings some sort of response for the environment, it does feel as though these emergency measures are going to be front and centre. What does it mean for food security and how we think about that?
Yeah, food security is an incredibly important risk of the worsening climate change crisis. In the UK, for example, we import 2/5 of our food from overseas, and that, about 16% of that comes from countries that are not just most vulnerable to climate change, but least resilient to dealing with it, least able to put these emergency measures in place and to adapt without the assistance of wealthier countries. So, that's a big chunk of, many countries are in the same situation. That's a big chunk of the food supply chain that is put at risk, not just by crops being hit by extreme heat, by drought, by flooding, which can wash crops away, but also heat stress impacting millions of farmers around the world. And it's not just the food that we import. Here in the UK, we've had a succession of wet winters followed by dry and very hot summers. This summer particularly chaotic, as you noted before heading into our 5th heat wave of the summer. Most of the country is now, most of England and Wales particularly, are now in drought. That's hitting farmers incredibly badly. And so that's going to hit our own crops that we're growing here as well. So it's a double whammy of those that we grow at home and those that we import.
Gareth, I mean, in terms of how quickly the effects of the impact on the harvest are felt, both in supply and prices on supermarket shelves, it's not going to be instant, is it? But presumably later this year, long since, by which point the heat wave will have passed, that's when people will start to feel the effects on their grocery bills and the availability of produce.
Well, I mean, two things. Of course, we're not starting from scratch here. We're not starting from this summer's heat being the start of the impact on prices. We've looked at some of the climate impacted foods around the world that we import, as well as those some of the worst harvests that farmers have seen in recent years here at home. And they've put, on average, about £360 onto UK household food bills across 2022 and 2023. There are 5 climate impacted foods that account for about 11% of the foods that we use to calculate inflation, but contribute 40% of the rise. So we can see this has already been happening, and already food prices are much higher because of climate change impact. So this is coming on top of that. So yes, there will be a lag in terms of the effects that happen now and when they play through into the food we buy in the supermarket, but it's on top of prices that are already elevated. And the second thing about all of this is that when the heat waves pass, these heat waves, these are all climate change. This is climate change making heat waves longer, more intense, more frequent. But when these summer heat waves in the northern hemisphere pass, we've got El Nino intensifying in the Pacific, already starting to, probably got its fingerprints all over the typhoon that is causing mass evacuations in China, for example. That's going to intensify through the rest of this year. That's going to get worse into the early part of 2027, probably going to make 2027 the hottest year on record, but that's going to hit crops all around the world as well. So this will be a continuing thing after these heat waves are finished, on top of price rises that are already hitting us because of climate change in all parts of the world.
I note that Andy Burnham will be chairing his first COBRA meeting, the UK's emergency committee, since becoming Prime Minister today. Those kinds of emergency meetings, they're reactive, aren't they? They're responsive. This isn't about dealing with the root causes. And I just wonder whether you get a sense that, not just here in the UK, but internationally, the political focus, the corporate focus on tackling climate change, it feels like it's not front and centre in the same way as it was a few years ago. Or is that just the headlines that I happen to be coming across anecdotally?
I think the emergency response is what it needs to be. It's the urgent adaptation, the urgent response, the urgent putting things right in the moment to protect lives and protect people, because these things are costing people's lives. But yes, the bigger issue, the bigger policy, which ought to be being discussed in COBRA and around cabinet tables around the world, is of course the only solution that we have to hand, the only scientifically available solution to halt climate change and to avoid these problems getting worse and worse, is to cut our emissions to net zero by the middle of this century. That means reducing and ending our reliance on burning fossil fuels, coal, oil and gas, for example. I think it does feel as though a lot of that is less front and centre than it has been in the past, but I think a lot of it is still happening. The UK, this government in the UK, whilst it may not be talking quite so much about the climate change measures that it's taking, is still speeding the progress from reliance on fossil fuels to renewables for electricity generation, for example. There are lots of things, however, that are harder to do than that, such as switching away from oil in our transport system, such as switching away from reliance on gas for heating homes in the UK. We've planned our whole the way we've built homes over the years and the way that we power homes. We've planned it around colder winters. Increasingly, we need to be planning it around colder winters and hotter summers. But there are lots of the harder bits, I suppose, of cutting those greenhouse gas emissions, getting us to net zero by mid-century, which governments have not had at the top of their agenda. The more that these extreme events, and they are extreme events, this is not just summer, this is extreme heat, the more that these extreme events hit us, the more that they harm people's health, the more that they cost lives. And we've seen 2,877 people died in the May and June heat waves in the UK, and the more that they hit the bottom line, hit countries' economies in the long term, the more these things will need to become front and centre if we want to make sure that this crazy hot summer doesn't become one of the coolest summers of the rest of our lives, really.
OK, Gareth, thanks very much. Gareth Redmond-King, Head of International Programme at the Energy and Climate Intelligence Unit. Coming up on the show, wind turbine maker Vestas raises its full-year outlook off the back of strong Q2 earnings. We will break down the results and speak to the CEO, Henrik Andersen, next.
talk about running sneakers as shares in On Holding sank 20% after the sneaker maker missed Q2 revenue forecasts while issuing a downbeat outlook. The Swiss company said it expects revenue to grow in the low 20% range for the year, having previously expected it to grow at least 23%. I think it's somewhat of a surprise given the amount of people that seem to be wearing these shoes, even for athleisure purposes. But the numbers are a surprise overnight. Now, elsewhere, Norway's sovereign wealth fund has posted record profits for the first half of the year, hitting $184 billion. It said the results were driven by good returns in the equity market, with a particular focus on Asian technology stocks. And a look at some of the stocks we'll closely be tracking at the market open. Bilfinger has confirmed its 2026 outlook after posting a beat on second quarter revenue. The German industrial service provider said signs of gathering momentum for the second half of the year were emerging, even as it pointed to volatile market conditions. TKMS has raised its full-year guidance after reporting a 19% jump in third quarter sales. The group pointed to strong demand for its sonar technology and frigates, along with upping its sales growth forecast to between 10 and 12%. Previously, it was at 2 and 5%. E.ON has posted a small beat on first half core profits that came in slightly above estimates. The energy service provider pointed to strong results in the industrials division and reaffirmed plans to invest €8.7 billion over the year for the next phase of the energy transition. We'll be speaking to the company's CEO at 8 a.m. London time.
The wind turbine maker Vestas has raised its full-year outlook after reporting higher than expected Q2 earnings. The Danish company's Q2 adjusted EBIT came in at €446 million. It's more than double analysts' estimates. Henrik Andersen, CEO of Vestas, joins us live now. Very good to have you with us. That's quite the smashing of expectations. What was at play there?
No, first of all, thanks. It's nice to be here on a quarter where it also shows some strength in the underlying. And I will say here, the underlying, we posted a 26% growth for total Vestas, and we post a 37% growth year on year on our power solution, which basically come from our strength in the onshore and strength in the offshore. So that whole part of installing wind turbines have worked really well in our Q2. It's one of the strongest Q2s we have had, and that comes down to better cost control on the projects, and again, a really stellar execution and support from also external partners. So we ended the quarter with 9.4% in earnings, which is a high quarter, but also what is leading to that we put a guidance for the full year to 7 to 9%. Which is, of course, a very good guidance to work towards. So 4.5 months to go, but very much pleased with the colleagues and team Vestas at the half year.
Henrik, I wonder if you can just shed any light on any conversations, any plans you have with data center providers about supplying them with energy, because one of the concerns I hear from time to time is that because wind power is not as consistently reliable as fossil fuel provided energy, the consistent supply of power to meet the demands for AI compute, wind power is perhaps less attractive to them. Is that the case, or are you having conversations about supplying power to these data centers in Europe?
I think we are in 2026, and I understand we often are brought decades back in what does happen if the sun or the wind is not blowing. But I mean, this is the upside. It's the story of renewables. But in 2026, you also have a completely different storage capacity building. And I think there are two main drivers on the demand side for electrons and therefore electricity is. You see it in the UK, you see it across EU, you see it across the world, that people are putting much more transport being electrified. So the whole electrification into transport. And then, of course, something we all talk about, and I think it was last quarter, I was asked for Steve if I had any opinions on a data center in space. But as I said here, on planet Earth right now, yes, we are building data centers, and data centers will have multiple sources of energy. And we also know data centers will be built to have both 20 and 30 years. and the storage and the technology capacity coming out of the generated electrons will only be better and stronger in the coming years. So I'm not so worried about that. But do you know what? The world will not consist of one energy source. So I think right now it's the pragmatism in all countries. So the strongest countries are the countries and societies where you are taking more of everything. And that goes also for the fossil. It also goes for the renewables, and it probably also goes now, as we can see, for the nuclear, because not meeting the demand side will have far more negative consequences. And of course, Vestas is well positioned to contribute and grow with that. So, in a company of our size growing in a quarter compared to 26%, I think I'm really pleased.
Henrik, it's Karen jumping in just to join the dots on planet Earth and given some of the news flow. And we've been talking about this huge financing for NVIDIA chips, a package that effectively builds AI factories across the world with every major financier on Wall Street involved in this. Does something like that brings AI to other countries and particularly to Europe have some bearing for you?
Yeah, sure. I mean, we'll be some of the ones. Listen, we have more than 200 gigawatt installed in more than 80 countries. So we are a user of AI already. We also welcome more compute and strength of the compute. We work closely with our partners in scaling that, not only for our energy generating assets, but also for our now close to 40,000 employees and how we work on a day-to-day basis. So I welcome that. But at the same time, it's also clear that I'm in part of that value chain. I'm in part of the beginning of that value chain, because none of this will work without energy in plenty volume supply. And I think we start seeing that in also some of the societies that people are running a bit scared that can we actually run our normal basics day to day for our consumers, our societies. And if you don't get that right, then you're running into troubles later on. So of course, I'm part of one of the first waves there. So it's not enough of building a data center if it doesn't have the right supply of energy.
Henrik, I just want to come back to the guidance because it was a little bit puzzling. The market thought that you might have upgraded the full year at the first quarter. That didn't happen. Now you have the stronger picture. And it's the EBIT numbers, a slight 1 percentage point increase on the EBIT line that has meant that you've increased the overall forecast for the year. It's not on the revenue line. Why is the revenue line also not going up?
I think the revenue was guided up already in the beginning of the year when we came out with our initial guidance, and we've kept that between our 22 to 22 billion. I don't think there's any surprise in that. We always have a back end loaded second half of the year. That's where most of the permitting, most of the commissioning of our power solutions will happen, of turbines. So it's not a surprise that I still have a sort of a back end heavy lifting in the second half of the year to do, and therefore coming out of the third quarter and Karen, we met each other that many years now that you know that the world is not as predictable as it has been. So therefore, for a CEO, you want to get a little bit into the year before you actually start upgrading. And when we come out in February and then only in May, I think what really positive gave us was the ending of Q2. We can see we've had some really significant positives, and of course we now have a visibility for second half of the year that does that. Hey, now it's time to show the strength in the underlying running and operations of Vestas. I'm really pleased with that.
I get the point around being conservative around forecasting, Henrik, given the challenges globally. And speaking of those challenges, it's not been the easiest permitting environment stateside. Just a quick line on that. What you're expecting now from the US for the rest of this year?
Yeah, no, and I've used that a little bit. The demand side is so strong that you are probably forced a little bit also to somehow bridge your sentiment or sometimes your subjective feelings around certain energy sources. When you have energy sources that are readily available and are fastest from planning, approving to energy, those are the ones you want to have much more of, and we see that. Then I also know that there are certain people that express differently around both wind turbines and solar panels and other stuff. But the truth of it is that it's competitive, the cost of it, and not least the speed and the security around these solutions are there to drive that much more. So you saw it also in the US. There was some judge at least saying start working in the Department of War towards those approvals again, because of course that volume needs also to get going. So I think the permitting is getting better.
Apologies, I must jump in. We've got to go. The market open is right upon us and we've got to squeeze into our break.
Hey.
Thank you so much. Henrik Andersen, CEO
you so
Investors.
much. See you soon.
Look at futures coming your way shortly. Market open. Welcome to Squawk Box Europe. It's 8 a.m. here in London, 9 a.m. CET, and the stock markets across Europe are opening up for trade. We had a slightly quieter day on Wall Street yesterday. A lot of the action really after hours, but the market just grinding slightly weaker. Europe too, just showing a little bit of fatigue after what's been a very strong run. We had a seventh positive session in a row in Europe, but it came with barely a tilt into the green. It was like barely a toe into positive territory. So on the back of that this morning, we are seeing slightly more action, a stepped up pattern where we've put on almost 0.2% out of the gates, Ben.
Yes, let's break it down for you sector by sector. And we saw that strong rally in the tech sector in the Asian trading session. That has filtered through to Europe. The tech basket of stocks advancing 0.02% there. That follows the positive updates we had overnight from Wall Street for supermicrocomputers and CoreWeave, really giving a bit of momentum back into the AI trade. Is climbing the board of gainers as I speak, but construction is currently leading the way, higher 0.8%. Basic resources also advancing this morning, as is the utilities sector as well. That's where we're seeing the biggest gains. In terms of the sharpest falls, this is the board of red, and it's media stocks that are down the most at the moment. Well, neck and neck with healthcare thereabouts, both off around 0.25%. Car makers and parts giving up some ground this morning, down 0.2%, 0.1%. Household goods also retreating in the first couple of minutes of the trading session. So that's sector by sector. Here's the picture broken down regionally, and a more positive start than futures had been indicating. The key bourses all trading above the flat line. It's the Italian market that's leading the way at the moment, up more than 1/3%. The London and Paris markets just a shade above the flat line. No dramatic moves there. We're awaiting a print from the Xetra DAX, but we'll keep an eye on that. Bring any significant moves as and when they appear. Karen.
We are keeping an eye on tech stocks at the open after a string of AI earnings beats around the world. CoreWeave surged after the bell after a top and bottom line beat, and Foxconn posted a 35% profit surge in the second quarter. Look at some of the big tech names and you can see all are rising today, more than 2% on ASML, ASMI. ST Micro a little bit left behind versus those bigger gains elsewhere. Infineon very strong as the chip plays all bounce on the market open. And let's get to E.ON, which has posted a small beat as first half core profits that came in slightly above estimates. The energy service provider pointed to strong results in its industrials division and reaffirmed plans to invest €8.7 billion over the year in the next phase of the energy transition. And let's get to the CEO. Leonard Birnbaum joins us, the CEO of E.ON. Leonard, thank you so much for joining us again. Great to catch up with you. No shortage of big news happening in your sector over the first half. The incredible developments we saw in gas and power prices thanks to the Middle East situation. Just explain it through your lens and some of the big challenges you were battling.
Yeah, indeed. We have been boring in meeting our results, but the environment is not boring at all. So challenge number one is from an infrastructure provider standpoint, and that is my largest business, actually providing infrastructure for energy. The demand for infrastructure is rising incredibly, and we can't keep up with the demand requests coming from the market, the connection requests coming from the market. So the real bottleneck of the energy transition is now about delivering sufficient infrastructure to integrate renewables. So that's challenge number one. Challenge number two, obviously, when we supply to our customers energy, the volatility in the markets and the high price levels that we have seen, especially on the gas side right now, is making it difficult for us to provide, obviously, cheap energy. We have seen 60 as a price level for TTF, 60 euros again yesterday, which is about 3 times what we have seen before the Gulf crisis. And obviously this is gonna, filter through into the price levels for our end customers. And we need to find a way to make sure that energy stays affordable. That's challenge number 2. And challenge number 3 is, since we are now really entering a new phase of the energy transition, in such a difficult geopolitical environment, we need to change the rules. And we have seen numerous legislative packages in Europe, in the different member states, and we have to cope with all of them. So those are the challenges, legislative ones, or regulation ones, operational ones, and geopolitical ones. So it's not a boring industry right now.
Never a dull moment as we have these discussions. I want to ask you, though, about the demand story. You should point to the affordability challenge of bringing the power at prices that can be afforded by many customers. Is there any sense that demand is now starting to trail off a little bit because of the elevated price that has been there for so much longer than many had hoped?
Yeah, on the gas side, yes, but obviously this is going to translate into a higher demand on the electricity side, and we see both. Clearly, when price levels go up on the gas side, there is a demand side reaction, and there needs to be one, so to make sure that the markets get into equilibrium again. So we see that on the gas side, but we especially see on the power side also slight increases, a bit higher growth than compared in the past. For example, we have seen a significant increase of e-mobility. and that e-mobility then translates also into higher power demand. So electrification, to be very clear, primary energy consumption needs to go down as a result of the energy transition. Electricity consumption needs to go up, and we are seeing right now a little bit of both, even though I have to say not enough on both sides.
To that point around the infrastructure challenge, we were just having a conversation with investors about the amount of demand that they're seeing and how they're providing that renewables bridge to the market, to the grid. What needs to happen from here for you to meet the connection requests that you were spelling out earlier?
Yeah, first, maybe I can just add to what you heard in the previous interview. We are seeing an unbroken addition of renewables into the system. So at E.ON alone, we have increased the capacity, the connected renewables capacity to our grid only by 10 gigawatts in the first half of the year. So from 120 to 130 gigawatts in half a year, which is a massive increase. But obviously this massive increase can't go on forever with the existing infrastructure. So what needs to happen is two things. On the financial side, we need to be able to attract the financing for the massive investments that we are making. And that means we need a regulation which is reflecting the cost of capital in capital markets. Because the good news is the capital is there, and there is capital that is willing to invest into infrastructure. That's on the financial side. On the regulatory side, we need faster permits, and we need an ability to prioritize between projects which are purely speculative, trying to actually secure a grid connection and sell it to somebody, from those projects which are really going to happen. And right now we are flooded with requests, and we have to process them in a first in, first out sequence, which means that we can't prioritize between projects which will not happen and those where we know that they will happen. And those are the changes that we need.
Leonard, across Europe, indeed across the world, many households and businesses are facing higher energy prices due to the ongoing conflict in the Middle East. There is this promise of reduction in costs for businesses in particular with AI and the efficiencies that can bring. But there will be some business owners out there concerned that whatever benefits financially they get from AI could be more than offset by the energy price rises that they could see as a result of the energy demands from AI data centers. How much do you think energy prices could potentially rise for households and businesses, given the demand from AI data centers, if more capacity can't keep up with the speed of the infrastructure build-out?
It's a difficult question, but I would push back on that one. First, if energy demand becomes really so massive that it's not acceptable for the system to cope with those costs, then the AI providers, the data center providers, will need to pick up that bill completely by themselves. And we are seeing that already in the US, where they are bringing their own generation to the system because they understand that they can't rely on the generation which is paid by the other customers in the system. The second one is, I would argue that any economy that is detached from AI will not be, a wealthy economy going forward. So if we say we rather have low energy prices by not having AI and then we are better off, I think there will be, yes, you might have low energy prices then, but on the other side, you will not have a competitive economy, and that's going to hurt our customers even more. So I think we need to find a way to benefit from AI, and having AI, especially also in Europe, and not being dependent on the end of AI happening only in the US and Asia. That would be the worst outcome of all.
Europe is currently in the grip of, several heat waves, and we've seen the climate impact of that. I was speaking to one of our earlier guests on the programme about whether companies still have the same drive and commitment to increasing renewable sources of energy. What's your position on that? Does it still remain as much of a priority for you at E.ON?
Look, I mean, our main business is about providing the infrastructure for the energy transition. And all I can tell you is I do not see a slowing down of the addition of renewables into any European markets. We are seeing an increase, especially on the PV side, but also on the wind side. I already mentioned 10 gigawatts being added only to the E.ON grid in the first half year. Also, if I look at the connection request for further renewables, I do not see a slowdown. So if I would say, no matter what's being speculated in the press, clearly a lack of renewables is not our problem. Renewables are a commodity by now. The real bottleneck is not whether we can add another gigawatt of wind or another gigawatt of PV. The question is whether we can add those gigawatts into the system. And the real bottleneck by now is the infrastructure, which is really maxed out in terms of its capacity. So if you want the energy transition to pursue, you need to put a different focus on infrastructure. And actually the European Commission and also the German government and some other governments have acknowledged that and are preparing respective legislative packages.
I was going to ask you about that. Do you feel your commitment to it is being matched by government policy across Europe?
On the one side, yes. On the other side, no. For example, I still believe that we are burdened far too much with permitting processes which are far too burdensome, just too complex. If I have especially in the high voltage, if a good permit process lasts 8 years, and if you look at the dynamics in the markets, for example, what has happened over the last 8 years in terms of data centers, batteries, e-mobility, then you have to acknowledge that this is just too slow. So whilst the talk is there, I want to see black on white changes to the rules that allow us to really adjust faster to reality.
Okay. Well, that's a clear message for any of them watching this morning. Leonard, thank you very much for your time. Leonard Birnbaum, the CEO of E.ON, joining us live on the show. Plenty more still to come up here on Squawk Box Europe. We'll speak exclusively to the boss of Hannover Re as the company posts a beat on its second quarter earnings despite currency effects weighing on results. Don't go away. We'll be back after the break. Hannover Re says it's on track to achieve its full-year guidance after posting a beat on second quarter earnings. Net income for the period came in at €695 million. It's ahead of estimates, while revenue also edged higher. The German insurer also said it booked a €29 million hit from currency effects versus a €170 million gain a year ago. Clemens Jungsthöfel is the CEO of Hannover Re and joins us live on the show now. Clemens, very good to have you with us. Walk us through the quarter then.
Yes, good morning and thank you for having us again on the program. Yes, as you said, we had a very good first half year, I would say, also a very good second quarter. So I'd say it was a successful half year with the operating income being quite strong in both business groups. So in our property and casualty reinsurance business, as well as in the life and health reinsurance business, we've seen strong underlying profitability. Our investment performance also contributed quite stably to our earnings. So overall, we are indeed well on track to deliver on our full year target, which is more than 2.7 billion of net earnings for the group. I should say that we've used the underlying strong profitability to further strengthen the resilience in our balance sheet, which is very important, particularly in more challenging market environments, because it's going to support our future earnings growth. So this is also worth mentioning.
In terms of payouts that you're having to make, has there been any change, significant change this year? Particularly, I have in mind in terms of natural weather effects, natural disasters. We've heard about floodings, we've got wildfires. What's the picture that you are gleaning from what you're seeing in your numbers?
Yeah, very good point. And thank you for mentioning that, because it looks like across the industry that it's been a rather benign Nat Cat first half year due to the large losses that we were budgeting. We ourselves came in below the budgeted number for the first half year. But that's just, if you just look at the landscape, and you mentioned a couple of the perils, so we see extreme weather events, we see earthquakes, we see wildfires, droughts. So the risk landscape is still quite severe. And if you just look at the recent picture of the earthquakes, devastating pictures there. So the risk landscape is still very serious. It's a very volatile environment. So the numbers shouldn't indicate that the risk landscape has changed to the positive. On the contrary, as you mentioned, in our case, we've seen a couple of large Nat Cat events in the first half years. To start with, Winter Storm Fern in the US and in Canada. We've seen earthquakes, wildfires, etc. All that will find its way into our numbers.
Clemens, I thought that was fascinating, the comment you made about risk and whether anything's changed. In terms of your strategy around climate, we've had a whole conversation this morning about river levels and some of the other challenges we know on a daily basis. There are wildfires, there's food security risks. Has anything changed in terms of the strategic approach that the business will have to climate change?
No, on the contrary. I mean, we need to be aware of the changes of the climate change, the perils changes that come with it. So what we've seen in recent years, tendency to away a bit from large Nat Cat loss events into more what we would call secondary perils, like wildfires, like droughts, floodings, etc. So that is still the case. I mean, in essence, this is what we are there for as reinsurers, to help our clients, our cedents, to navigate that increased volatility in relation to climate events, and ultimately to help society to at least mitigate economic risks coming with this and really helping to stabilize it. That's what we are there for. We constantly need to adapt our models. That's what we are doing on a yearly basis. We adapt our modeling, our prices, etc. And together with preventative measures, I think we should, as an industry, be helpful and be able to tackle this together with all parties involved.
Can I get to some of the price action? For many years, we've been talking about the inflationary impact on insurance, and I can see this line saying prices on renewed business fell 4.5% on inflation and risk-adjusted basis. Just unravel that. What is happening here? Is it suggesting we're coming off some of the heat and the inflation pressures on insurance products?
Yes, I think we need to look at this in the larger sort of view of the reinsurance cycle. So we've seen quite substantial price increases, improvements in terms and conditions in more recent years, which have led to the fact that, and actually based on a prolonged time of soft reinsurance markets with prices that were not always adequate. So we've seen strengthening of prices, and prices now coming down due to the fact that there is quite strong earnings in the industry, that there is capacity in the industry, both from traditional and from alternative capital. So prices coming down from a peak level, I'd say, still being adequate. And therefore, we always need to make sure that prices remain adequate. But on a broad base, we still believe that that is the case. And that's why we were able, that's why we were willing to provide coverage, to support our clients in tackling those issues.
Clemens, I can see at the same time that volume went up. So what does that suggest about the amount of demand for product?
Yes, I think the demand is, I mean, it's twofold. Some of our cedents have, due to their stable balance sheet, strong balance sheet, have retained business, so not ceding it out. Others, and we spoke about the perils, we spoke about the risk landscape, there is still demand for protection. I think we as Hannover Re have supported our clients for many years on a broad base, so the strong client relationships, the partnership approach that we have, where we support our clients on a broad basis, as well as our substantially lower cost ratio than the industry with our lean operating model. I think that allowed us to grow our book, to gain further market share, and to support our clients.
Clemens, I want to ask you a question that may not be overly futuristic, even though it may sound like it, but I want to talk about mobility in future, because we're going to have the CEO of Wave on the show a little bit later on, talking about autonomous cars being rolled out into major cities, not just San Francisco, but also London. I gather this is going to change the ownership structure of cars in future if we see wide-scale adoption at some point of autonomous. No doubt this is a huge insurance issue as to who you insure, how you insure this type of technology, who has liability. How is the industry, how is Hannover Re thinking about some of these big changes, structural changes for the industry?
Yes, it will not be autonomous cars. It will generally the speed of technology changes that we see coming from AI, coming from autonomous driving is very rapid and is increasing at a breathtaking speed, I would say, in some areas. So we need to stay close to our clients, to the ultimate policyholders, to see what is the needs. The perils, the risk might change from just, let's say in your example, from insuring that car itself to more product liability or liability cases. So we are going to adapt, we are going to explore together with our cedents to come up with options. Clear is we are going to be part of the risk-taking solution. Our industry will play a role also in trying to develop new products to support that environment and that development, which will clearly happen.
Okay, Clemens, thank you very much for your time. Clemens Jungstoffel, CEO of Hannover Re. Iran's newly appointed Supreme National Security Council Secretary has doubled down on Tehran's stance that the Strait of Hormuz will remain closed unless the US accepts a series of conditions, including an end to the war and release of frozen assets. This despite mediators on Tuesday signalling progress towards an agreement. Separate attacks on shipping also raising escalation fears. The US said it disabled a Panama-flagged vessel attempting to violate its blockade against Iran, while 6 people were killed in a suspected Houthi attack in the Bab el-Mandeb Strait. With a full update, Dan joins us now. Dan, it feels like the two sides still nowhere near reaching an agreement to reopen the strait, plus this renewed tension in the Bab el-Mandeb Strait. Just bring us completely up to date with what you're hearing and the picture that's there now.
Well, Ben, first to the markets, and we are seeing oil prices pushing higher again today as these fresh attacks on shipping and a stalemate over the Strait of Hormuz effectively reduce any near-term pathway of an agreement. Brent, of course, briefly returning to 90 USD overnight. Meanwhile, on the water, the US Energy Secretary Chris Wright says almost 9 million barrels a day are now moving through Hormuz on a 7-day average. Total oil flows out of the Gulf at around 15 million barrels a day, according to the Energy Secretary. But that Hormuz number remains well above some of the estimates that some of the independent tanker trackers have been sharing. So there is some skepticism around the scale of the recovery, but it is interesting to see the administration talking about the amount of barrels and the amount of ships that are actually moving through Hormuz at the moment, particularly as the security picture remains very fragile. In the Gulf of Oman, the US military says a Navy helicopter fired 2 Hellfire missiles to disable a Panama-flagged cargo ship that it says was ignoring warnings and tried to breach the blockade on Iranian ports. And then you also have this development in the Bab el-Mandeb as well. 6 people were killed in attacks on a cargo ship there, 4 crew members and 2 rescuers, according to Yemeni authorities. Diplomatically as well, there's some mixed signals here. As you mentioned, no real breakthrough. Pakistan saying Washington and Tehran are close to some sort of deal. Qatar also saying that these talks over managing Hormuz are advanced, but Iran still refusing to reopen the strait until the US accepts its conditions. And of course, the president also outlining America's own list of demands, meaning that both sides still remain very far apart. So the message for markets today is that while oil flows may be improving, you have these 2 key shipping routes still under pressure and, of course, no political breakthrough yet. So as a result, the risk premium staying elevated. And as I mentioned, Brent back to 90 USD now.
Dan, thank you very much for bringing us the latest. Ahead on the show, rate bets sit on the knife edge ahead of today's CPI print out of the States. We'll get you set up ahead of the US session.
Hello, welcome to Squawk Box Europe. I'm Ben Boulos with Karen Cho, and these are your headlines. Tech stocks take a lift, tracking gains in South Korean chip names after order backlogs from CoreWeave and Supermicro surge, lending support to the AI trade. Norway's sovereign wealth fund posts a record $184 billion in first-half profit as investments in tech, telecoms and energy pay off. Vestas shares on track for their best day in over a decade as the wind turbine maker blows through second quarter earnings expectations. CEO Henrik Andersen sounds a bullish note on the sector.
It's one of the strongest Q2s we have had, and that comes down to better cost control on the projects, and again a really stellar execution and support from also external partners.
Futures in a holding pattern as investors await the latest US inflation print. The headline figure is expected to come in at 3.4%, with no clear consensus on how the Fed moves next. Well, if you want to know what investors moving cautiously looks like, well, it looks a bit like this. A mix of red and green on the board, not too many deviations away from the flat line. Markets lacking clear direction. Of course, all the focus on the US inflation data that is due out later today. The implications from that about how the Fed moves in its September meeting on interest rates. Is seemingly inflation pulling in the opposite direction to the data on jobs. Inflation suggesting a hold or a hike might be necessary. The jobs data from last week suggesting that a cut might actually be necessary. So investors, unsurprisingly, moving cautiously. The sum of all of this plus the other key regional benchmarks means that currently the pan-European stock 600 is trading just a shade below the flat line, but no big dramatic moves as things stand this Wednesday. In terms of the best sectors, these are the strongest performers on the pan-European index. Oil and gas is up there at the top of the board, up almost 1%. We have seen the oil price advance after those entrenched positions from both the US and Iran in terms of what they would demand for the Strait of Hormuz to reopen. On top of that, the trouble and the attacks on shipping in the Bab el-Mandeb Strait by the Houthi rebels. That is all fueling concerns about energy supply, pushing the oil price up and lifting the stock of oil and gas majors. Construction, basic resources, industrial goods also on the board of outperformers. Just one to mention, actually, in terms of energy, Vestas. We mentioned the impressive set of results that the energy company, the wind turbine maker, had posted for the most recent quarter. That has pushed it to be the top gainer at the moment on the stock 600, up around 18% on the day. There you go. You can see its share price really reflecting investors' satisfaction with those latest figures, taking its gain yearly, 12 months, up almost 80%. So let's have a look at where we're seeing the sharpest falls this morning on the stock 600. These are the worst performers. Healthcare stocks down around 1%. Household goods off by more than 0.8%. Retail also down by a similar amount, and car makers and parts retreating as well. That's the picture in Europe. Let's cast an eye ahead at what is being anticipated for the Wall Street session. And again, a bit of a mixed picture. The S&P 500 and the Nasdaq being called higher, the Dow being called lower. This after the Dow posted back-to-back losses and we saw the Nasdaq close lower as well. We got those results from Supermicro and CoreWeave after the bell, so this will be a chance for investors to react during market hours. We saw their share price and after hours, both of those companies jump. The focus today will be on the CPI report. Could well be pivotal for the Fed's next decision in September. Indicators are all in place to push investors to expect another hot inflation print. Brent crude trading around 25% higher since the start of the Iran war. That has helped to push the annual CPI figure up by nearly 2 whole percentage points since the start of the year. Inflation coming in at more than double the Fed's target back in May, raised expectations of an interest rate hike, but then look what happened in June. The print came in markedly lower than expected, as did the figures for the other part of the Fed's dual mandate, employment. The US economy actually started to shed jobs, according to July's non-farm payrolls report, which came in, look at that, at minus 23,000 versus expectations of an 80,000 uptick. Now, today's inflation figure is expected to come in at 3.4% on the year. That's nearly 1.5 times the Fed's 2% target. Yet investors, look at this, very much on the fence, 50-50 pretty much on what that means at the FOMC's next decision in September. What do the banks think? Bank of America says that June's soft figure was a one-off and that a strong print today will put a September hike in play, pending next month's PCE reading. Meanwhile, Wells Fargo points to the spectre of stagflation, especially after July's negative jobs print. Karen.
I feel like we've heard everything around what the Fed may or may not do this year over the course of the last number of months. But let's get to Paul Jackson, global market strategist in Invesco. Paul, you might be the same, looking at all these expectations that are changing on a weekly, monthly basis. What's your view on whether we get a rate hike in September and whether it's consequential for the markets at all?
Well, morning, Karen. I think it is a confusing moment. I suspect that the CPI print today, if it comes in line with expectations, and I think inflation will come down just because of what the oil price has been doing in recent months. So we're going to get a bit less inflation than we had in the month of June. That probably helps the Fed to stay on hold, and the employment report that we had last week with job losses, but very importantly, wage inflation coming down. That I think is an important set of data that will help the Fed or persuade the Fed that maybe they don't need to raise rates at this moment in time. And then it depends a little bit what happens to the price of oil. It depends probably a lot when it comes to headline inflation, not so much core. But if oil prices do continue to trend lower, and they're up today, down tomorrow, we just don't know from one day to the next. But if they do continue to trend lower, then I think that will help keep those inflation prints coming down.
When I said whether it's consequential or not, whether the Fed moves, that wasn't meant to be a throwaway, but more a what's going to kill the party that we're seeing on the markets at this stage. It feels like there is a bit of momentum back. It's around an AI trade. And if we got one rate hike, whether it would really derail some of this market enthusiasm, because let's face it, we're not going to get forward guidance at all. So the market is guessing what's happening when it comes to interest rate policy. So my point was, look, one rate hike, would it make a difference anyway?
Well, I think it depends on the interpretation. If it's a rate hike in a series of rate hikes, then that could make a difference. But frankly, I don't think the US economy or the inflation rate is at a place where the Fed would feel that it needs to keep hiking, partly because in its own terms, it is still running a slightly tight ship. The Fed's estimate of neutral is around 3%, and the policy rate is 3 3/4. So the Fed's policy rate is above what the Fed itself thinks is neutral. So I don't think they're going to hike and then keep going. But for sure, if they did that, then that could be problematic for the markets. But yes, a one-off cautionary rate hike, I don't think that's going to change things.
Just to be clear on the pathway, though, you have an expectation that perhaps by 2027 we do start to see that lever adjusted when it comes to interest rates. What impact would that have?
Yeah, and the reason that I think that is it's basically a cyclical phenomenon. I think that inflation at the end of the day, we get this volatility because of energy prices, but over time inflation is a cyclical phenomenon. As the labour market tightens during economic expansions, wage inflation goes up and that pushes your price inflation higher. And I would imagine that over the next year or two, if the economic expansion continues, and we're in the 7th year now, if that expansion continues, then you do get that tightening. Commodity prices, commodity markets also tighten. And central banks will naturally be tightening into that. But I think if in the early stages that tightening is seen really as it's just because the economy is doing well, then I think that markets, the stock market, can kind of resist that and can coexist, the market rally can coexist with that. It's only when you get to the later stages of tightening, when central banks are really starting to squeeze the pips and trying to really slow the economy down, that is when market rallies and these market expansions, I think, come to an end. And I don't think we're there yet.
In picking up on that note, Paul, we've got the issue of food prices rising, not just because of the fertiliser prices that has been an issue since the start of the Iran war. There's also been the climate and the heat waves and the flooding that we've seen and the wildfires. We've also got the prospect, potentially, if the Fed hikes rates, we've got a lot of political uncertainty. How well positioned at the moment are markets to withstand those potential wobbles?
Well, I think if you've gone through any strong movement in the markets, there's always a risk that a wobble turns into something more serious. And I think there are still parts of the market, and if I look globally, there are still parts of the global equity market where there are, I think, areas that are perhaps overextended, and I think it still relates a lot to the areas that are benefiting from the AI trade. And that AI trade has been going through waves. We had, to start with, the hyperscalers that did very well, then the people supplying the hyperscalers, then the people supplying the hyperscalers, their stocks struggled, and the trade moves on elsewhere. It might have moved back a little bit to the hyperscalers. So it's kind of a rolling, I wouldn't necessarily say a rolling bubble, but it is a rolling rally that is going from one area to another. So I think that area could be vulnerable, especially if interest rates were to rise rapidly. On the food inflation question, yes, that is going to be something that we're going to have to deal with, but it is less important than energy as an input to price inflation. But there are other parts of the market, that I still think that small caps are attractive. I think your bog standard industrials, if you've got an economic expansion, you would expect things like industrials to be doing well. You would expect basic resources, the metals and mining stocks, to be doing well as that economic expansion continues. So I don't think it has to be a catastrophe for the whole market. I think there's still plenty of opportunity out there.
Where's the defensive position if people are worried? If they see the inflation print coming higher, they worry that a Fed potential hike in September could weigh on equities, on the main US benchmarks, for example. Where's the safe place to be? Is there one?
Well, Ben, I think if you're worried about inflation, it's really hard to find something that is defensive. There are very few assets, never mind within the equity market. If you're worried about the inflation being caused by rising oil prices, then obviously energy stocks are the place to be within equities. If you're worried about food price inflation, then ironically, very often the food and beverage sector does quite well, which seems counterintuitive. But yes, their input costs may be going up, but the food companies, the food manufacturers, tend to have pricing power. The same doesn't necessarily apply to the retailers, but the food manufacturers do, so they are able to increase their output prices at the same rate as the input prices, which means, hey presto, profits go up at the same rate. So that is a sector that if food inflation is driving the problem, then that could give you some protection.
One of the things I've noticed since starting this job at the beginning of the year is that so many analysts and strategists are broadly in line with each other on their consensus. One of the things that stands out is your Aristotle list, 10 improbable but possible outcomes for 2026. I just want to pick up on one, and whether maybe you're ready to cross it off, the yen. You were saying that you think it could fall, the dollar could fall to 140. As we sit here and speak, there's been massive intervention within the last week, joint intervention, we understand, between the US and the Japanese authorities, and yet it has given up the yen has given up so much of the gains that resulted in. It's now creeping back up to 160. What's your take on that and the implications for global investors?
Well, first of all, the reason why I would expect the yen to strengthen so much is that it is dirt cheap. If you look at it in real trade-weighted terms, it's more than 40% below historical norms. And the reason why it became so cheap was because the interest rate spreads widened out. The 3-month spread between the US and Japan was more than 6% at one stage a couple of years ago. That spread is narrowing, but it's not narrowing fast enough because the BOJ is going so slowly in terms of tightening. And the intervention that they've been doing, it will never work if there isn't monetary policy action behind it. And that monetary policy action in this case is that the Bank of Japan would be tightening more rapidly. So, no, I'm not ready to give up because there are a number of BOJ meetings still to go, and there's always hope. I don't turn the clock off until the 31st of December on those sorts of things. Yes, I did think England would reach the World Cup final, so that one clearly
I wasn't going to mention that one. I wasn't going to mention that one.
Hasn't happened. It was so close, but yet so far. But the yen, I think, once it does start moving, and if the BOJ were to give indications, and I think it has started to give indications that it needs to tighten more rapidly, but if it puts that into practice and the markets start to believe it, and you get more intervention at the same time, then it could build up some sort of steam that would lead to dramatic strengthening, but we're not there yet.
Let me squeeze in a quick political question, because we have seen a record high on the French stock market so far in recent trading sessions. You've broken cover and you've mentioned the French presidential election. We all know it's coming up, but in terms of tying it to one sort of stock market move here, is the French market at the best of the best trading patterns now? Would you be cautious around holding on to it for further momentum? And how are you thinking about French assets as we count down to that big parliamentary election moment? Presidential election moment.
Yeah, my guess is, the presidential election itself, you're looking at April, May of next year, it's going to be quite an open race with Marine Le Pen now in the race. I think she's got a reasonable chance of winning, but it's by no means guaranteed. So there's going to be uncertainty. Markets don't like uncertainty, so you might get a bit of volatility. But like most political changes that we observe, at the end of the day, the markets, you get a little bit of volatility and then they move on. What is happening in the economy is usually much more important than who is running the country. And I don't think that even with a change to a president such as Marine Le Pen, I'm not convinced that the economic change would be radical, and therefore I think the market would carry on its merry little way.
So you're still favourable around French stocks?
Yeah, I would say, and I think the oat market, the French government bond market, is relatively attractive. The spread is pretty good. It's not to say it can't widen during the election campaign, but I think it's okay.
Paul, thank you so much for joining us. Plenty to think about there, plenty of trades. Paul Jackson with us, global market strategist at Invesco.
Coming up on the show, AI tops the agenda amid a slew of earnings beats around the world, and as Norway's sovereign wealth fund reaps the benefits of its Asia tech investment. We'll bring you all the details after this short break.
Wind turbine maker Vestas has raised its full-year outlook after reporting higher than expected Q2 earnings. The Danish company's Q2 adjusted EBIT came in at 446 million euros, more than double analysts' estimates. We spoke to Vestas CEO Henrik Andersen earlier on the show and asked him if renewable energy can help meet the power demands of data centres.
Yes, we are building data centers, and data centers will have multiple sources of energy. And we also know data centers will be built to have both 20 and 30 years. And the storage and the technology capacity coming out of the generated electrons will only be better and stronger in the coming years. So I'm not so worried about that. But do you know what? The world will not consist of one energy source. So I think right now it's the pragmatism in all countries. So the strongest countries are the countries and societies where you are taking more of everything. And that goes also for the fossil. It also goes for the renewables. And it probably also goes now, as we can see, for the nuclear, because not meeting the demand side will have far more negative consequences. And of course, Vestas is well positioned to contribute and grow with that. So in a company of our size growing in a quarter compared to 26%, I think I'm really pleased.
Let's spend some time on CoreWeave. The shares have surged in extended trade after the key AI bellwether hiked its capex forecast on the back of earnings that beat on both the top and bottom lines. Interesting to note that you saw that backlog to $104 billion. Some of the analysts are saying, look, this is a massive contracted backlog guarantee giving rare multi-year visibility on revenue. That was from Zacks, a key strategist. Now, our colleague Christina Parts-Neveles filed this report.
CoreWeave posting yet again record revenue. After selling off the day after earnings 5 quarters running, the stock finally got rewarded, up double digits after hours. CoreWeave buys AI chips, packs them into data centers, and rents that compute out to companies like Microsoft and OpenAI. It also sells software and developer tools, so it's not just a landlord for AI. The company did report $128 million in operating profit and sees expanding margins into year end. The catch, though, is debt. Heavy interest really increased their bill there and still pushed CoreWeave to a net loss of roughly $626 million, though that came in narrower than Wall Street had feared. The backlog grew to $104 billion, with more than $25 billion in new commitments added early in Q3, so it's increasing, though the pace of growth is slowing. Active power, which is the capacity actually switched on and billing customers, it reached 1.5 gigawatts, more than triple a year ago, but that's less than half of what CoreWeave actually has under contract. Closing that gap is the bet. As more power comes online, revenue and margins are supposed to follow, so another bullish point. And watch the NVIDIA connection. NVIDIA owns roughly, 12% of CoreWeave and just unveiled on Monday $500 billion in financing pool to help customers lease its chips. As the middleman between NVIDIA and the big AI labs, CoreWeave could benefit. For CNBC Business News at the Nasdaq, I'm Christina Parts-Neveles.
Our US colleagues will be speaking to the CoreWeave CEO Michael Intrator at 2 o'clock London time. Don't miss that first conversation on CNBC.
Norway's sovereign wealth fund has posted record profits for the first half of the year, hitting $184 billion. It said the results were driven by good returns in the equity market, with a particular focus on Asian technology stocks. But the CEO of the fund, Nicolai Tangen, sounded a cautious note on Tuesday, saying it's possible the fund could, quote, disappear in the event of a market collapse. Well, Asian tech stocks have been on a roller coaster this year, with Korea's Kospi index ending last month down by more than a fifth, even as it posted its best day on record. The Norwegian fund booked a return of more than 30% in its Asia and Oceania-based investments in the first half. NBIM has also revealed details on its stake in SpaceX for the first time. For more details, check out cnbc.com. It's interesting, I picked up on that point with Nicolai Tangen at the NBIM Investor Conference in Oslo in the spring. And I said to him, look, you've really benefited from the rally, the stonking rally in AI stocks so far this year. Do you not feel that to insulate against a downturn, you perhaps need to reposition? And he said, we do not try and time the market. We track global equities. It's a diversified fund. If you ride the wave on the way up, you have to accept there'll be moments where you ride the wave on the way down. If you start trying to time the market, that's when you miss out on the big rallies. So very much of the view that it's inevitable when you are a market participant in that way, you have to accept that there could be a downturn, which completely tallies. There's a real consistency there with the warning that he's sounded that there is the risk of a downside. But, if, you know, to quote someone else, if you want the rainbow, you've got to put up with the rain. It's
an incredibly passive stance from a sovereign wealth fund in terms of managing a gigantic amount of money. And no doubt, as you point out, I mean, the technology wave, and particularly in some areas, it has been incredible. There have been triple-digit returns in various different parts of, you know, trading AI in the last couple of years. But this whole point, and this was the commentary that came out in the last 24 hours or so, that they could sustain a heavy loss. And the wealth funds value that is currently, what, $2 trillion, could even disappear altogether in the case of a market collapse. I mean, given that the economy also rides on a lot of this investment, somewhat worrisome about the blowback of risk here for Norway itself.
But then I think, you know, they have been stewards of this wealth from the energy wealth that they have in a way that, you know, they don't draw down despite political pressure at times to do so.
We're going to park that for now. Coming up in the show, oil prices extend gains as shipping attacks raise fears of further escalation in the Middle East. We'll bring you the IEA's latest market assessment as it crosses the wires. Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. The IEA forecasts a further fall in world oil demand as disruption in the Strait of Hormuz takes hold, while oil extends gains as attacks on shipping heighten supply concerns and raise fears of escalation in the region. Tech stocks take a lift, tracking gains in South Korean chip names after order backlogs from CoreWeave and Supermicro surge, lending support to the AI trade.
Norway's sovereign wealth fund posts a record $184 billion in first half profit as investments in tech, telecoms and energy pay off. Futures are in a holding pattern as investors await the latest US inflation print. The headline figure expected to come in at 3.4%, with no clear consensus on how the Fed moves next.
We have the IEA report just crossing the wires this morning, so let's just dig into a couple of the top lines as it hits the tape. World oil demand is forecast to decline by 1.6 million barrels per day this year, and it's talking about the estimate was at 510, more than their estimate in last month's report. The ongoing closure in the Strait of Hormuz and elevated fuel prices are weighing on oil consumption. So that is, the higher price of energy does constrict the demand situation at some point. Annual contractions will nevertheless ease from 4.9 million barrels in the second quarter to 2.8 million barrels by the third quarter before returning to growth in the final quarter. So in terms of charting that, you do see a slowdown before a pickup. So when it comes to oil supply, that's risen by 2.4 million barrels per day in July, but also remained below year-ago levels. Renewed hostilities and maritime disruptions in July and August undermine the recovery efforts of reducing projected third-quarter oil supply. In terms of pushing onto refinery crude, and this has obviously been a crunch point, the amount of product going into those refineries has been impacted. Refinery crude throughputs increased further in July, but remained nearly 5 million barrels per day below year-earlier levels. So putting it in hard, fast numbers about the impact. And global throughputs are now forecast to decline by 2.5 million barrels per day on average in the second quarter this year, before rebounding by 3.5 million barrels per day in 2027. Tighter light and middle distillate markets boosted cracks and margins in the Atlantic Basin to record highs. And just a line on inventories from here, global observed oil inventories plunged by 69 million barrels in July, given those renewed disruptions to exports from the Gulf and the Caspian Sea resulted in sharply lower volumes of oil on the water. So that is the latest as we dig into that report. Anything more we'll dig out for you in due course. Let's get to the latest meantime from the Middle East, as Iran's newly appointed Supreme National Security Council Secretary has doubled down on Tehran's stance that the Strait of Hormuz will remain closed unless the US accepts a series of conditions, including an end to the war and release of frozen assets. This despite mediators on Tuesday signaling progress towards an agreement.
Separate attacks on shipping also raising escalation fears. The US said it disabled a Panama-flagged vessel attempting to violate its blockade against Iran. Meanwhile, 6 people were killed in a suspected Houthi attack in the Bab al-Mandeb Strait. Dan joins us now. Seems like things are just as uncertain as they have been at any other point this year, Dan.
That's right, Ben. And the biggest new security flashpoint is now the Bab el-Mandeb Strait, where, as you've just mentioned, Yemen's Houthis have been blamed for a deadly attack on a cargo ship there. 4 crew members were killed. 2 Yemeni rescuers were also reported killed in a follow-up strike. And that attack is raising some fresh concerns over traffic through what is still one of the world's most important shipping routes. And it also comes after the Houthis said they would impose a naval blockade on Saudi Arabia in the Red Sea as well. And then at the same time, tensions, of course, remaining high in the Gulf of Oman. The US military saying overnight that a Navy helicopter fired 2 Hellfire missiles to disable a Panama-flagged cargo ship that it says was ignoring warnings and tried to breach the US naval blockade on Iranian ports. All of this also coming as we see hopes for a quick end to the US-Iran war continuing to fade here. Iran continuing to say the Strait of Hormuz will remain closed unless Washington accepts its own conditions, and President Trump saying the US remains in control of the waterway in any case. So this is still very much a war of words. The narratives playing out on both sides, making some confusing signals for the markets and for oil traders, as we see crude now pushing back above $90 a barrel in the early Asia session, and Brent holding around that level as we speak. And then you have the US Energy Secretary Chris Wright also weighing in the last couple of hours, saying almost 9 million barrels a day are now moving through Hormuz, with total regional oil flows at around 15 million barrels a day. Now, this is really interesting because that Hormuz estimate is well above some of the independent tracker figures that we follow. So what this basically signals is that the US is really attempting to ensure that the market is getting the message that ships are moving, barrels are still hitting the supply side. But of course, what that actual number looks like remains to be seen, because the lack of clarity around exactly what's moving on the water and getting independent figures confirmed is still quite challenging at this point. So for traders out there, the oil flows might be improving, but it seems as if the security risk around both Hormuz and the Bab el-Mandeb is getting worse, and all the while still no diplomatic breakthrough to end this conflict as well.
OK, Dan, thank you very much. We're going to have a quick look at the sector gainers in European equities this Wednesday morning, and it's oil and gas leading the way higher, up by almost 1%. This tracking the jump in the oil price that Dan was referring to there, as all that uncertainty continues around the Strait of Hormuz and the Bab el-Mandeb Strait and the ability to get oil and gas out of the region. Jumping to the top of the Pan-European Stock 600 this morning, the biggest gainer was actually Vestas, the wind energy company, after posting some strong results for the most recent quarter. Rounding off the board of outperformers, construction, basic resources and industrial goods. Where we're seeing the biggest falls are among this lot here. Healthcare down 1.34%, household goods retreating significantly as well, and retail giving up almost 0.9%. Food and beverage stocks down around about 0.75% as well. Investors positioning very cautiously, waiting for the inflation print for the month from the United States. That has really kept moves on markets fairly subdued. You can see the S&P and the Dow being called either side of the flat line. The Nasdaq is anticipated to open higher. This after a day in which all three benchmarks closed the session lower, but we got after the bell some impressive numbers from CoreWeave and Supermicro Computer, and after hours their shares have been climbing. So this will be a chance for investors to respond during market hours, helping to rally some of those tech stocks, which of course overly represented on the Nasdaq. Karen.
Yeah, a story of AI visibility coming through from the likes of CoreWeave. Today's CPI report could well be pivotal for the Fed's next decision in September. Indicators are all in place to push investors to expect another hot inflation print, with Brent crude trading around 25% higher since the start of the Iran war. That has helped push the annual CPI figure up by nearly 2 whole percentage points since the start of the year. Inflation coming at more than double the Fed's target in May raised expectations of an interest rate hike, but then June's print came in markedly lower than expected, as did the figures for other parts of the Fed's dual mandate, employment namely. Now, the US economy has actually started to shed jobs, according to July's non-farm payrolls report, which came in at minus 20,000 versus expectations of an 80K uptick. Today's inflation figure is expected to come in at 3.4% on the year, nearly 1.5 times the Fed's 2% target. Yet investors are very much on the fence on what that means at the FOMC's next decision. What do the banks think? Bank of America says that June's soft figure was a one-off and that a strong print today will put a September hike in play pending next month's PCE reading. Wells Fargo points to the spectre of a stagflation, especially after July's negative jobs print. George Brown is with us, senior economist at Schroders. George, we have heard a lot of varying commentary this morning, even from our own interviews, which is that, look, the Fed's going to look through any hot print. They've got the catalyst for the direction of travel here, that lower inflation is on the way. Anything that we see is not going to move the needle on a Fed decision in September. What's your view?
So I think today's print is going to be pretty pivotal in terms of whether or not we get a September hike or whether they decide to hold. But ultimately, our view at Schroders is that they are going to tighten. It's very clear, listening from the comments from the various FOMC members, that they're turning more hawkish. If you look at underlying inflationary pressures, they're looking really elevated. We have our own proprietary measure of capacity constraints. That's at a 35-year high. The economy is doing really solid. And markets now are starting to question, well, why isn't the Federal Reserve hiking rates? We obviously had the 3 dissents in the July meeting. And I don't think Walsh did a very good job, I think it's fair to say, in terms of communicating why the Fed hadn't taken the decision to hike rates in July, and hence we saw that big sell-off in longer-term yield. So I think in terms of they should hike, definitely the data is calling for that. But then I think there's a credibility issue as well that they need to address. And whilst you can sound hawkish in order to address some of that, that will only take you so far. And so actions speak louder than words. Ultimately, we do think the Fed is going to be hiking.
That is fascinating, the whole credibility issue separate to the data, because to the point, when you do get messaging from some of the different members that they are concerned about elevated price pressures and lingering for longer than one would like, then you do get some messaging around timing. But Kevin Warsh has made it pretty clear he does not want to provide any visibility, any clarity on what that may look like, just even sort of confounding investors even more. What sort of premium does that start to attach beyond what we've already seen in terms of those longer end and even shorter term yields?
Yeah, well, certainly the premiums could go higher. We've seen some of that start to be baked in. Like I say, if we do get if the data doesn't change between July and September, we're looking at a very similar economy than we did back at the July meeting, and the Fed decides to hold, and we get that kind of still muddled communication from Walsh, I think you're going to start to see those premiums start to be baked in more at the long end of the curve.
The thing is, George, if inflation came down from 4.2% to 3.5% in June, and the jobs data would give some ammunition for justifying not hiking rates, the loss of jobs that was published last Friday, and yet we saw the yields move higher despite a lack of action at the last meeting, might the Fed not be tempted to think, well, actually, the market is doing all of this itself without the need for the Fed to move rates, and of course they can then have almost the benefit of rates going up, but without the risk of politically upsetting the president, who certainly doesn't want to see them raise rates?
Well, that would certainly be Walsh's argument. That's what he was sort of trying to communicate to the market in July. But the market was saying, well, hang on a minute, we're not stupid. The reason that the yields have risen higher is because we're expecting you to hike rates. Now, you're right, there could be a scenario where inflation's really soft, we get a big downturn in the labour market. We're not confident that is the case. And that then might see some of those hikes come out. And so the strategy might be to sound hawkish in the near term and not deliver. But certainly from what we're seeing in terms of all the macro indicators, we certainly don't think that's going to be the case. So in terms of the labour market, for instance, we had this slowdown this time in 2024 and 2025 in the summer months. And what was that followed by? It was followed by a pickup in job gains in the winter. So I don't think that come September, October, December, they can necessarily stay on hold and convince the market that that's the right decision. I think the market really does expect them to hike. And if they fail to deliver those hikes, I think there's going to be some pressure at the long end of the curve.
But then, correct me if I'm wrong, I don't have the exact figures to hand, but I seem to remember that when we got the jobs print, not only was the most recent month it posted a loss of jobs, but previous months were revised downwards. So it may seem like the jobs market is doing okay when we get the monthly figures, but then, they go back and revise them, and actually the picture doesn't look quite so rosy.
Yeah, I'm going to fall foul of what a lot of economists do and blame the surveys and say that the surveys aren't giving you a true picture. But I do genuinely think that is the case. Lower response rates and that volatility that you're talking about, I just don't think, as investors, we should be putting as much weight on the payrolls as we have done in the past. But ultimately, the market does, so of course it does react. Instead, we're putting a lot more weight on the hard data because there's no survey issues there. And if you look at like initial jobless claims, for instance, that has remained stable throughout the last few years. Really, really good, reliable, dependable statistics. And actually, if you look at it at the moment, it's the lowest it's ever been for this time of the year on a non-seasonally adjusted basis, going back to 1967. So you're right, we've got these really mixed messages on the labour market. And at Schroders, we're just preferring to put our emphasis on the hard data rather than the soft data, which we think there's these methodological issues with the surveys.
Let me plug in the story we're seeing around AI. Huge investment off the sidelines. It means we're seeing chipflation has come into the mix. Long term, there is a view from Kevin Warsh and others that AI will be disinflationary. We'll see some of those price pressures come off, but it doesn't feel as though we're getting to that side, having an economic impact just yet. I mean, the message from a lot of tech players is, look, the benefits of AI are not coming through just yet. And if that is the case, we're not going to get the disinflationary impact either. So what is the pathway to that disinflation from here? How long is it going to take?
Yeah, that's a great question. I totally echo those remarks as well. I think Kevin Walsh has made this really strong assumption that you will get this huge productivity and that will drive down inflation. And he ultimately might be right, but at the moment, that's a massive punt on something that just hasn't been proven. And like you say, we are getting that higher inflation now through the higher memory costs and the semiconductor costs. In terms of when we actually might see that disinflation, we have to see the adoption rates of AI pick up massively. We have to start seeing real-world tangible examples about how AI can reduce costs. And we can all speculate on what they will be, but until those are adopted and deployed, which is probably going to take, let's be realistic, quite a few years now, we're not likely to see those benefits. So ultimately, the direction for rates might be lower over time as you start to see those benefits. But in the near term, given that we're seeing that inflationary pressure from not just isolated to, but in terms of the AI inflation, the chip inflation that you're talking about, that is going to necessitate tighter rates.
Of course, if the Fed does move higher with rates, it almost certainly strengthens the dollar, which, again, the president is not keen on as he tries to address that trade imbalance that he sees. I mean, we've seen that intervention in the yen. A stronger dollar inevitably means, relatively the yen is weaker. So how much does that... I mean, I know it's not the Fed's mandate to worry about the strength of the dollar. Its focus is on price control, controlling price rises, and supporting the jobs market. But that is an inevitable consequence if they move, isn't it?
Yes, I mean, it's not the Fed's mandate yet. Let's see what the task forces say, I suppose. Look, ultimately, a stronger dollar is what's good for the US economy. It's a reserve asset. That's ultimately what they ought to be pursuing. Obviously, the president takes a different view on this. But in terms of what's going to drive that going forward, it's going to be rate differentials. And so if you look at the market right now, they've priced in a lot of hikes from the Bank of Japan. We don't disagree with that. In fact, we think there might be a little bit more in there, but it's broadly baked in. Where it's not baked in is in terms of the Fed. There's still this sort of, as you said at the start of the segment, economists and investors are on the fence about whether the Fed is even going to start to hike rates. So if we're right and they do start to tighten, then of course that's going to give some strength to the dollar in the near term. And I think for the president, he's not going to be too happy about that.
OK. George, thank you very much. George Brown, Senior Economist at Schroders. CoreWeave shares surged in extended trade after the key AI bellwether hiked its CapEx forecast on the back of earnings that beat on both the top and bottom lines. The company now sees CapEx coming in at $39 billion this year. That's up $4 billion from the previous top end of its range. This as it reported a revenue backlog of more than $100 billion. That's up nearly 250% on the year, with another $25 billion in net new customer commitments so far this quarter. That will bring a measure of welcome certainty to investors, especially as CoreWeave says more than half of the backlog is attached to a contract where customer delivery has already begun. Our US colleagues will speak to the CoreWeave CEO, Michael Intrator, at 2 o'clock London time. Don't miss that conversation first on CNBC. Meanwhile, shares in Supermicro Computer rallied almost 8% in extended trade after the data center infrastructure company topped expectations for Q1 earnings and revenue guidance. The company now expects up to $15.5 billion in first quarter revenue, ahead of an estimated $11.7 billion. Coming up on the show, Wave leads the way, moving a step closer to autonomous rides in London. We'll talk through the key milestone with the CEO of Wave. That's Alex Kendall, who'll join us here next.
Self-driving taxis could soon become an everyday reality in Britain. Just last week, Transport for London granted a private hire licence to a fleet of autonomous vehicles using Wave's technology. The British AI company is planning to roll out the taxis in London as part of a partnership with Uber. Alex Kendall joins us now, the CEO and co-founder of Wave. Alex, this felt like a huge announcement the other week. Just tell us how it stood in terms of the company's own plans to bring autonomous to market.
Well, it's an exciting one for us because we've been developing this technology for about a decade. So it hasn't happened overnight, but I mean, London is such a busy, diverse, challenging city to drive in. And so we're very excited about this opportunity. I mean, we're looking to bring our AI out into all kinds of cars, from consumer-owned vehicles to robotaxis. And I think the opportunity to actually, for the first time now, expose public to our technology is a big milestone for our team.
100,000 Londoners have joined a list over at Uber, an interest list, which means they get a chance to be some of the early riders in the vehicles. What's still left, though, in terms of regulatory hurdles to make sure this is safe for those 100k Londoners who may be stepping into one of the cars in the fleet?
That's right. So we're going to launch later this summer, and you'll be able to call these cars through your Uber app. But from here, it's not going to just happen overnight. We've got a journey to go and grow that we're going to do very considered in a very considered way. So from the launch, we're going to start with a supervised service with our prototype fleet. And so this is a service where there'll be a safety driver present in the vehicle, but you'll be able to experience a fully autonomous journey from unlocking the car through your app to getting in and experiencing an autonomous ride. And I think that's going to be a very exciting glimpse of the future for many people. But from there, we have a couple of key steps. Of course, the first one is we're going to be moving from these vehicles to manufacturer-produced vehicles, and we've announced great partnerships with the likes of Nissan and Stellantis to build these robotaxis at scale with us. And then secondly, to work on validating the performance on these vehicles and getting the next license, the autonomous scheme, to be able to actually operate with no safety driver present in the vehicle. And so that's the journey that we're going to be going through, and that will result in a driverless, occupantless vehicle that can be driven on public roads here.
Alex, when are these first journeys going to happen in London?
Oh, good question. We're going to stay tight on the exact announcement, but it's later this summer, so you won't have long to wait.
This summer, so that could be later this month then, August.
You'll have to wait and see, but we're excited. I took one of these vehicles home last night. We're testing it internally. I'm pretty excited about the experience, and so Londoners won't have long to wait.
Okay. In terms of the compute power that's needed behind the technology, how does that work? And do you see that there is enough capacity from data centres at the moment to support the technology to the scale that you would like to see it roll out in London? And if so, what sort of partnerships and deals are you doing? Who is providing that compute power for you?
Well, it's interesting when you compare the, everyone's been talking about compute in the case of cognitive AI, language models, knowledge work, things like this. When you think about embodied AI, bringing AI to robotics in the physical world, the dynamics are slightly different. So firstly, when it comes to inference, actually running the compute, that's all on the car. And so there's not a need for large-scale data centers for actually running the AI model. That's all on the robot, on the car, on the edge. For training, though, we do need data centers. Now, they're not as significant as language models. Robotics models tend to be smaller in parameter count, but have much larger data requirements. The data flowing into our vehicle is gigabytes a second. So we need data centers for training, and we've been partnered with Microsoft Azure for many years. They've been a great supporter, investor, and of course, a cloud partner for us. So that's where we train. And then as for data, we've got partnerships with many of the leading fleet and manufacturers around the world, and our business is really to aggregate that data and train the most frontier, safe and scaled physical AI model.
I just ask, we're all getting very excited about this, but there'll be drivers who make a living from private hire themselves, really worried that their livelihood will go. What do you say to them?
Oh, I think that's an important question, and I mean it impacts many industries because AI is not just going to affect physical world, but it's disrupting many different industries. I think ultimately I would like to see the disruption that AI can bring into driving to be a real benefit for society. I appreciate that is going to come with some disruption to some jobs. I think it's important to make sure that we are transparent about the impact of these. We work with various stakeholders to make sure that we can do this in a responsible way. It's also, as I said, not going to happen overnight, and there is going to be a choice. The market, I think, will determine what that distribution of transportation options is. I'm sure London's going to continue with a rich and vibrant diversity of options, from walking, cycling, public transport, and driverless vehicles for people who choose that. Ultimately, our role is to build technology that's going to provide a much safer driving experience. It's still really tragic how unsafe our roads can be. Over 99% of incidents on roads are due to human error, and I think with autonomy we have an opportunity to drive that down to as close to zero as we can make it. So that's primarily one of the outcomes that we're pushing for with this, as well as the other benefits autonomy brings by giving people time back. And of course, this is not just in taxis, but also for consumer vehicles and other mobility services around the world.
Alex, let me just bring up some other negative headlines. There was a lot of negative publicity around an event in San Francisco recently. One of the US papers broke ranks on this and published some of the detail, effectively talking about a fireworks event in San Francisco, that Waymo roads blocked intersections effectively were part of a gridlock problem. The batteries died. There were events where one of the cars apparently drove over some fireworks. These are called so-called edge cases. Some unknowns here where the technology simply doesn't know how to respond. How do you fix that? Because it also brings into front of mind if there's a hacking situation where the technology simply can't recognize that it's a simple thing that can be avoided because it was designed to cause harm.
Yeah, these are very important questions, and I think there's a lot that we can learn from some of the early robotaxi deployments in places like San Francisco and Shanghai and other cities around the world. What's exciting about the technology that we're launching is we think of it as AV 2.0. It's a next generation approach to driving. What that means is that it's the first generation of autonomous vehicles has really been built around infrastructure that tells these cars where and how to drive. So they follow high definition maps that map the streets, and they've got rules that tell them how to behave in certain scenarios. And they also often rely on network infrastructure to be able to operate, which leads to some of the challenges that you just described. With our technology, we're moving to an AI era. We've been, for the last decade, pioneering this new contrarian approach that brings an end-to-end deep learning model into the car that has all the intelligence on the vehicle to make its own decisions. What this means is that it can drive in new places it hasn't been to before, or if the road changes, if there's an event, roadworks, or some change in the environment, it's not following a set rule or map, it's making its own decisions with what it sees. So I think there's the opportunity for us to build a system that's more intelligent, more human-like in its driving, and can seamlessly fit in the busyness of the cities we're in. One good example is in the pick-up and drop-off maneuver. Our car does not have fixed, mapped places where it should pick up and drop off. It makes a judgment call about where it's legal, safe, and socially acceptable to be able to pull over and double park the car to be able to pick up or drop someone off. That's just an example of how I think we can build a more seamless experience with this next generation approach.
And let me just bookend a conversation too with a question on insurance, because we spoke to Hanover Re this morning, the CEO, about how the industry is thinking about designing insurance products for future mobility. Given the changes with autonomous, it feels as though car ownership is going to change in a big way, and how you insure those products is going to have to change too with the industry. What conversations are you having at your end around how that should look in future?
We're talking with many of the major insurance brokers and reinsurers, because what we're going to see is a big shift in the next couple of years for the 100 million vehicles that are sold each year. There's going to be a very rapid introduction of this technology. For example, our AI is going to be empowering hands-off and then growing to eyes-off driving technology, L2 and L3, in cars built by manufacturers like Nissan and Stellantis and others. And so this is going to what this is going to do is it's going to increase the safety and comfort of driving, and then also for commercial vehicle owners and fleets, of course, that really utilize vehicles 10 plus hours a day. This is going to drastically reduce the of course the incident rate because a lot of this is due to distracted or impaired or some kind of distracted driving. It's going to increase the decrease the time to be able to resolve a claim, because you've got cameras surrounding the car. You can immediately resolve what happened.
Right.
And so ultimately, this is going to provide a significant efficiency boost in fleets through autonomy.
Okay, Alex, fascinating stuff. Thank you very much for joining us. We look forward to the launch. Can't wait, whenever it may be. Alex Kendall, CEO and co-founder of Wave. Well, from one of the newest technologies to one of the oldest assets known to humans, gold continues to trade higher as the market awaits any clues on the Fed's next move. We will discuss the outlook for the metal right after this break.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. Tech stocks take a lift, tracking gains in South Korean chip names after order backlogs from CoreWeave and Supermicro surge, lending support to the AI trade. Norway's sovereign wealth fund posts a record $184 billion in first-half profit as investments in tech, telecoms and energy pay off. Futures in a holding pattern as investors await the latest US inflation print. The headline figure expected to come in at 3.4%, with no clear consensus on how the Fed moves next. The IEA forecasts a further fall in world oil demand as disruption in the Strait of Hormuz takes hold, while oil extends gains as attacks on shipping heighten supply concerns and raise fears of escalation in the region. A quick look at the trading day so far, just over 90 minutes into the session, and we're not gaining much ground. You can see the DAX, the Italian market, the FTSE MIB holding on to patches of green, but elsewhere we're offset with some selling for the FTSE 100 here in the UK and the French stock market down by about 1/3%. So real patchwork session playing out. The sectors where you are seeing that improvement, don't forget there's still a big focus on the Strait of Hormuz, the higher energy prices and still the uncertainty that is ongoing. That is being reflected in the price action, the spot price, but also so too in the sector itself on oil and gas, which is marched higher. Construction, that is a firmer trade today. We've seen some appetite around basic resources of late and again finding a foothold in this session. Telecoms rallying 0.6%. And I think the telecom side here really down to the AI journey we keep on hearing about. Some of the after hours action states are again giving us more clarity about how long the earnings journey may be with us around AI for now as that demand story plays out. And contracts, orders have been placed and the backlog seems to be growing for some of these AI players. Telecoms here in Europe are part of that mix. Now, the sector losers, where we are seeing some selling catch up with the boards this morning, it's around healthcare. It feels as though AstraZeneca had a big impact on markets with that surprise M&A activity. Even if it's not going to progress from here, the sector itself is down. And part of a broader conversation, I think, around what M&A takes place still in big pharma from here. Household goods down by 1%, retail, food and beverage giving back some territory. So some of the big consumption plays under pressure in Europe this morning. Speaking of which, it's all about CPI stateside. We're waiting it out for the headline figures to cross, what the core looks like as, again, we face those pressures from the Middle East. The early trade this morning looks firmer. You can again tie that to the after hours numbers we saw from the likes of CoreWeave and Supermicro that crossed in the session.
Spot gold prices are trading modestly higher once again after slipping from a 10-week high in the Tuesday session. This as investors await that US CPI print today and any clues it might offer on the Federal Reserve's next rate move. Suki Cooper is Global Head of Commodities Research at Standard Chartered and joins us in the studio. Suki, good to have you with us. What is at play there? What do you see are the main factors affecting the gold price at the moment?
We've seen gold switching back to some of that tactical positioning that matters a little bit more in the short term. Ultimately, we think it will revert to structural drivers. We're still seeing good central bank demand, but this week in particular, that CPI print is key. And as you said, we've seen markets pricing in a lower probability of a rate hike in the September meeting. And we've seen some of those key macro correlations starting to matter again. So with real yields, the dollar, inflation expectations. And as those expectations have been scaled back, gold has been able to breach some of those key technical levels, trading above that 100-day moving average again.
But that said, we've seen the price rise towards the end of that graph. It is staging a bit of a recovery. But if there were to be a rate hike, which the inflation print has been above target for some time now, why would an investor want to hold an asset that's non-yielding when they can get a much better return either holding cash or treasuries?
We think that we've seen a notable shift from wanting to hold gold as a tactical investment to more a strategic investment. So those structural drivers, whether it's the official sector wanting to continue to hold gold to be able to diversify their portfolio, or investors for that matter, are looking at gold as a percentage of a portfolio rather than some of these short-term headwinds that might materialise. So over the longer term, we can see that on a portfolio allocation basis, gold holdings are still relatively light. And importantly, we've started seeing some of those ETF flows starting to pick up at the start of August, and already as the market has started to price in a lot of these macro headwinds already, we're starting to see gold prices moving higher. So we think that's a reflection of the light positioning in the market.
As you drill down to those ETF flows, is that the retail or institutional investor getting back involved in the gold trade?
It's a combination of both. The price high that we saw in January was really driven by retail demand, but now from the ETF perspective, it tends to be much more institutional demand. And what's interesting is that it's not centred in one particular region. It's across the US, it's across China. We're seeing inflows starting to materialise on a global basis again.
You heard a lot more about the barbell approach to investing. It seems to be back. That does typically bring gold back into a portfolio to a greater extent, doesn't it?
Yes, we do tend to see that when a lot of these factors are aligned for the market, that's when we see a lot more momentum supporting this price as well. But what's interesting is that we're in the middle of a seasonally weak period for consumption, and as we enter August and September, we'll see much more structural support materialising for the market. So we see more upside risk from here.
So just to round out the gold trade, what's it going to take to get us back to the highs that we saw earlier this year? What are the catalysts we need to see in play?
So we have 4,650 as our Q4 average. So we do see prices heading back towards 5,000. But to retest those record highs, we need to see some of these headwinds dissipating. So that I would include structural demand materialising from the official sector, which we're already starting seeing materialising over the past couple of months. But a lot of the investor appetite needs to firm as well. We're starting to see signs of that with the ETF demand. But that jewellery headwind that we're seeing, much weaker demand, that needs to dissipate. So we think that when we see markets refocusing on de-dollarisation risks, concerns around fiat currency debasements, global debt, that's when we're starting to see gold reach that 5,000 level.
Just moving on to silver, I mean, unlike gold, silver has far more sort of industrial uses, solar panels, within tech as well. But it seems that a lot of the excitement around silver has ebbed away. What's your take on what's happening there?
If silver is our barometer for uncertainty and industrial demand, gold tends to be much more focused on the macro perspective. For silver in particular, it tends to do much better when the industrial demand is firming, but also we tend to see that investor space. And one of the big concerns that we're seeing in the silver space at the moment is the solar industry substitution risk being replaced by copper, for instance, whereas that retail demand has also started to slow down. Yes, there's AI demand that's supporting some of the industrial consumption for silver. Electrification of vehicles is supportive as well, but there is that risk of substitution that's offsetting that. So in the near term, there's still a little bit of concerns around economic growth or inflation expectations weighing on the industrial side of the silver market. But it's still a market that's undersupplied and has been undersupplied for the past 5 years. So the stocks are depleted and it makes it a much more volatile market.
Can I bring up the AI story and what we're seeing? Because the trend that we've had during earnings season is to reinforce that demand is very much real. The cycle is intact, and some companies' visibility out to 2028. What does that mean for the metal space?
When we look at some of that structural demand across the metal space, here we're probably looking at silver, mostly copper, for instance, there is that growth perspective. And from the data centres, we are seeing much more consumption being driven, supporting the industrial outlook. But having said this, there's still a lot of concerns when we look at the outlook in terms of balances going out to 2026, 2027 and onwards, whether we'll continue to see that same pace of growth. If we see a slowdown in terms of data centres being built, then there will likely be a slowdown in the supportive picture for a lot of these metals. But we're seeing not just demand being driven from AI data centres, it's much more of the whole ecosystem that's driving a lot of this consumption. So yes, it's providing a boost on the demand side, but I think the big picture here is that the supply hasn't been able to keep pace, and these are markets that are likely to be undersupplied.
So a big move in the price action from here is what you're calling?
For silver in particular, yes, I think there's more scope for price risk to the upside.
Suki, thank you very much for joining us today. Suki Cooper with us, Global Head of Commodities Research, Standard Chartered. Extreme heat warnings have been issued in Britain and France this week, with temperatures set to reach around the mid-30 degrees Celsius. Governments have taken action. More than 27 million people in the UK are facing water use restrictions as Brits face their 5th heat wave this year. UK Prime Minister Andy Burnham is set to chair an emergency COBRA meeting this afternoon in response to the sweltering heat. This June and July have been the hottest on record in Western Europe. That's according to the European Union's Climate Change Monitor. Research shows the region's average temperature across the 2 months was almost 3 degrees Celsius higher than usual. The report warned climate change is intensifying extreme weather conditions, with heat and drought reinforcing each other across the region. Well, Sam has been digging into this and the consequences across here in the UK, but also across in Europe. What jumped out to you the most?
Yeah, it's an interesting question. I suppose the economic impact. I mean, we're seeing Europe's rivers falling to record low levels after an exceptionally hot summer, and that's affecting both the Rhine and Danube rivers, and that's led to some pretty extraordinary and desperate measures to try and rectify the issue. So if we take Romania as one example, we've seen these extraordinary images of naval forces conducting a controlled explosion in the River Danube to try and improve the water flow to its cooling systems to help its nuclear power plant run effectively. And then looking over to Germany and the Rhine, where cargo traffic has been severely disrupted in what is Europe's traditional growth engine, and that's likely to significantly impact its economic growth story. So this water security issue, it's a known challenge, but as the climate gets hotter and these droughts become more severe, then these economic fault lines, these rivers are coming under real pressure.
I learned something from this, reading your piece online. The extent, even just in Europe, across southern Europe, 30% of the population, nearly 1 in 3 people in southern Europe, known to be in areas with permanent water stress. This isn't something that should have taken governments and policymakers by surprise. They've known that this is an issue.
It's long been an issue, and we're seeing some emergency responses happening now. You alluded to the British government even having an emergency COBRA meeting today. We understand that in Romania the issue could get even worse as soon as tomorrow. There's some suggestion from their authorities that Romania's last working nuclear power plant could have to shut down as soon as tomorrow because of those low water levels on the Danube. So it shows you that this is a real issue, it's an ongoing issue, and it needs tackling.
To me, it says a story that there could be a fight over resources in future. I mean, we're talking about member states in Europe that have a governing body, works together to combat challenges like this. But it may not be as simple as talking about partnerships across countries. It feels as though we could be sort of really almost spoiling for a fight around some of these resources, especially water.
It's a big worry. Yeah, it's a huge and pressing issue that, as I say, does need tackling. I did see some analysis on the economic impact of this issue. This is the hot summer that we've been living through and still have some weeks to go, of course. But the Dutch bank Triodos had assessed how this hot summer had impacted the EU's GDP and found that it's hitting the EU economy to the tune of about 180 billion euros, which actually might sound fairly modest, but it works out as roughly the equivalent of 1% of GDP. So I understand that EU is expected to grow about 1% this year, and that would wipe out its economic growth for 2026.
I think it's an extraordinary story, especially if you're on the other side of the world. You have this picture of Europe and a picture of the UK as being just permanently green because there's so much water and temperatures are not such an issue. Then you look at the reality here on the ground. I mean, I'm struggling to keep a couple of plants alive in the garden because it's so hot, even with watering them every other day.
Absolutely.
Yeah. Sam, thank you so much for joining us. And for more, you can read Sam's full piece over at cnbc.com. Wind turbine maker Vestas has raised its full-year outlook after reporting higher than expected Q2 earnings. The Danish company's Q2 adjusted EBIT came in at 446 million euros. That's more than double analyst estimates. We spoke to Vestas CEO Henrik Andersen earlier on the show and asked him if renewable energy can help meet the power demands of data centres.
Yes, we are building data centers, and data centers will have multiple sources of energy. And we also know data centers will be built to have both 20 and 30 years. And the storage and the technology capacity coming out of the generated electrons will only be better and stronger in the coming years. So I'm not so worried about that. But do you know what? The world will not consist of one energy source. So I think right now it's the pragmatism in all countries. So the strongest countries are the countries and societies where you are taking more of everything. And that goes also for the fossil. It also goes for the renewables. And it probably also goes now, as we can see, for the nuclear, because not meeting the demand side will have far more negative consequences. And of course, Vestas is well positioned to contribute and grow with that. So in a company of our size growing in a quarter compared to 26%, I think I'm really pleased.
Coming up on the show, AI tops the agenda amid a slew of earnings beats around the world, and as Norway's sovereign wealth fund reaps the benefits of its Asia tech investment. We'll bring you all the details after the break.
Just digging into numbers from Tencent this morning, and the reality is we've seen a pickup in the profit line, but it is still a miss on expectations. 58 billion yuan anticipated, but crossing around the 56 billion yuan mark instead. When it comes to Q2 revenue, that was up 11% year on year. The company is citing growth in AI services, video content, gaming as key drivers on the outlook, highlighted ongoing progress in AI-powered applications, infrastructure, sustained marketing services, revenue growth, increased video views. And I think this line's interesting. It sees breakout user growth for WorkBuddy and strong performance for new games. So that's where it sees some of the interest, increased engagement too on video content, time spent on Weixin video accounts driven by enriched content, new features, supported revenue growth. When it comes to gaming, domestic and international games, including new releases and evergreen titles, achieved record user engagement and receipts. So this is the point around whether AI can encourage further engagement. That is what we're looking at. But I would say there's been a lot of caution around China tech with some of the fund managers concerned about margins, concerned about the competition, and whether the investments are reaping the returns that they would hope to achieve at this point. So the line that you had here around AI services was that growth in AI-powered products and infrastructure, including the launch of HY3 model, contributed to revenue gains. So I think it's still wait and see, not like the blowout numbers we've seen from the United States when it comes to the AI plays just yet. So just a little bit of caution around the stock, and you can see what the reaction has been like too in the stock of late. It is still showing that cautious behaviour.
Foxconn reported a second quarter beat as it posted a 35% rise in net profit to just under 60 billion Taiwanese dollars, beating estimates. The electronics manufacturer, a key player in the AI build-out space and a key partner of NVIDIA, said that AI infrastructure was driving the results, with it expecting strong AI demand throughout the rest of the year. Norway's sovereign wealth fund has posted record profits for the first half of the year, hitting $184 billion. It said the results were driven by good returns in the equity market, with a particular focus on Asian technology stocks. But the CEO of the fund, Nikolai Tangen, sounded a cautious note on Tuesday, saying it's possible the fund could disappear in the event of a market collapse. Well, Asian tech stocks have had a bit of a roller coaster so far this year. Korea's Kospi index ending last month down by more than a fifth, even as it posted its best day on record. The Norwegian fund booked a return of more than 30% in its Asia and Oceania-based investments in the first half. NBIM has also revealed details on its stake in SpaceX for the first time. For more details, you can check out CNBC.com.
CoreWeave is leading US tech stock names before the bell after its part in a string of sector earnings beats. Its top and bottom line coming in above analyst expectations. Supermicro also coming out with bumper numbers, soaring well above expectations. But for me, it's CoreWeave, and it's about that visibility of the runway. There are real fears out there of overinvestment. CoreWeave has been very much at the forefront of some of those fears, taking the chips, building out compute, and then renting them back to the industry. But what it was talking about here in terms of the backlog from future sales from recurring customers, so customers that it's already got wanting more of the service, $104 billion. So that is a near doubling of the order book that was reported back in November. Quite a big step up when it comes to demand. And for me, it was the reaction too from the investor community saying, look, the massive contracted backlog guarantees a rare multi-year revenue visibility. So when you hear it, this rally has been sustained by the earnings. This is exactly what we're talking about.
And I think, you know, all of that it tallies with this idea that many of our strategists have said, which is look beyond the hyperscalers, look beyond the big tech companies, look to those providing the infrastructure that's needed to meet that demand for the compute, because without these companies you can't build those data centers.
Well, this is trapped in that circular loop with NVIDIA, but the reality is the earnings are still there, aren't they? We're going to wrap it up for today.
Yeah, that's it for today's show. I'm Ben Boulos with Karen Cho. Morning Call is coming up next, so don't go anywhere. We'll see you tomorrow. Bye-bye.